Welcome, ladies and gentlemen, to my free 10+ hour trading course. And this is a special moment for me because what you're about to watch is something that I've spent hundreds of hours building over the past several years. This isn't a quick upload or a repackaged tutorial. This is the most complete beginner to advanced day trading education that you will ever watch. And I am posting the entire thing on YouTube completely for free. And I say this with full confidence. My free course is genuinely better than most paid courses on the internet. And I'm not just saying that because it sounds good. I'm saying that because over 60,000 students have gone through my free course, applied it, and they told me that it changed the way that they trade. Thousands of them became profitable traders for my free course alone, and many of them told me it was far more valuable than any $500, $1,000, or even $5,000 program they bought from another guru. This video is special because it represents years of hard work, years of charting, experimenting with trades, taking winning trades, taking losing trades, losing money, making money, and reverse engineering everything that a beginner needs to know to finally become profitable. And for the first time ever, I'm making it available for the entire world, and I want to tell you why. My name is Emmanuel, and 5.5 years ago, my father taught me how to trade. He was my trading mentor, and without him, I would not be a profitable trader today. And everything I teach in this course, every single concept came from the foundation he gave me. My goal is to now continue his legacy and lead the next generation of profitable traders the same way that my dad mentored me. My free course covers absolutely everything. It covers the basics. It covers the fundamentals of price action, strategies, support and resistance, how to use indicators, how to scan, trade management, trade psychology, how to scalp. Literally everything that you can think of is included in this course. This is truly the final blueprint that a beginner needs in order to finally become profitable and remove all of the guesswork from their trading. And I truly believe no other trader on YouTube has released something like this completely for free. Not at this depth, not at this level, and not at this quality. And that's why I'm so excited that you're here today. So if you're serious about becoming a profitable trader and you're tired of being confused, you're tired of being inconsistent, and you're tired of piecing together concepts from random YouTube videos, I want you to lock in. I want you to be distraction free. I want you to take notes, and I want you to focus on everything that I'm going to teach you in this free 10+ hour course. And if you do, you will be unrecognizable as a trader by the end of it. It's crazy because this free course genuinely means so much to me. It's a symbol of my hard work over the past few years, and I am confident it'll be the most impactful trading video that you will ever watch. And before we get officially started with the course, for a better viewing experience, my free 10+ hour course is also in my free private community where I'm going to be sending you way more other free resources such as frameworks to build a trading plan, PDF documents of the concepts that I talk about in the course. I even do free bi-weekly live training. So to get access to my private community, which like I said is 100% free, you can go to the description of this video. You'll be able to click on the link and you'll also be able to watch the free course there and get access to all of those free materials. By the way, my goal is to be as transparent and as real as possible because I think that is something that's severely lacking in the trading space. And over the past 12 to 13 months, from November 1st of 2024 to November 29th of 2025, which is today, I've made over $559,000 in day trading profits, which is a cumulative rate of return of over 372% on my entire trading account. This is my Charles Schwab brokerage login. I use Thinkorswim platform, and if you're thinking this is a screenshot that I edited or if this is Photoshop, I will go ahead and refresh the page. And if I do that, over the past 1 year exactly, actually, I've made over $481,000. And if we go back to the same dates that I showed you before of November 1st of 2024, there's the $559,000. I actually had a really good November in 2024. And I'm also happy to show you my personal brokerage statements as well. This is from 2025. And I started the year off in January with a really good month. I cleared over $53,000. And then we had the whole tariff situation where the market dropped over 20%, and I actually had my best month of the year where I made just about $69,000 in February. And March was also a nice month. It's gonna show that I lost money in March. My change in period balance is negative 3,000. However, I withdrew $47,000 from my account that month. So I actually made $44,000 in March, which was also a nice month. And my slowest month of the year was actually in June, where I only made $10,850, and that is because I was in Europe and I only traded about 20 to 30% of the time. You know, everyone has to take a vacation, so I was mostly in Europe. I went to Barcelona, Portugal, Amsterdam, and London. I did some trading on the side and ended up making a little bit more than $10,000. And I'm also happy to show you the other months as well. It was overall a super green year. Every single month was green for me. I did not have a single negative month this year, and I'm really looking forward to continuing that trend into 2026. And yeah, the reason I'm showing you this is to be transparent and to show you that I actually make money with trading. I do this for a living. This is my passion. This has been my career for over 5 years. And everything that I'm going to teach you in this free course, I personally use on a daily basis to make money. Let us begin this free course by talking about the fundamentals of trading. Let's talk about the basics. And let us first define what trading actually is. And trading is when you're buying and selling a financial asset, whether it's a stock or a crypto, or it's gold or silver or oil or wheat, or it's an options contract. You're buying and selling a financial asset based on technical analysis and price action. This should not be confused with investing. I see a lot of people confuse the two. A lot of people think that trading is investing. It is not. As investors, we try to determine the intrinsic value of the asset that we're looking at. And based off that intrinsic value, we can determine whether the asset is overvalued or undervalued, right? And in order to figure out the intrinsic value, most of us look at the financial documents of a company. We look at balance sheets, income statements. We're looking at industry trends. We're looking at the news. We're reading analyst reports. We're understanding the cash flow the company has. We're understanding the assets that's on the balance sheet. We're looking at the fundamentals of the company or of the asset that we're analyzing. And based off those fundamentals, we determine, is it overvalued or undervalued, right? When you think of investing, you should think of Warren Buffett. What he does is invest in companies long term, and that's how he makes his money. He is not trading. When you are trading, you are solely looking at price action. You're not looking at any financial documents or news or fundamentals or anything. We solely look at the price action. And in this course, I'm going to dive really deep into what price action is, and there's going to be other videos that go over company fundamentals and investing and the real differences between technical analysis and fundamental analysis. But a short little summary: price action is the study of how prices move. And what we do as traders is we analyze how prices have moved in the past. We analyze what prices are doing right now, how they're moving currently, to analyze, to speculate, and to ultimately make money on what prices are going to do in the future. That's what we focus on as traders. We focus on technical analysis and price action. That is it. A question that I get asked all the time is trading gambling? And in order to answer this question, we need to define what gambling is. And by definition, gambling is betting on the uncertain outcome of a future event, meaning you don't know what's going to happen in the future, and you're betting that prices are either going to go up or prices are going to go down. By definition, trading is gambling. However, the connotation around gambling is that it's impossible to become successful as a gambler, I guess. And I don't really like to call trading gambling. I think trading is really similar to poker or blackjack in casinos, where if you're a really good poker and blackjack player, if you understand what you're looking for, if you have an actual edge, you're going to make money. And the same thing applies for trading. And in trading, just like in blackjack, we shift the probabilities of the trade in our favor by developing what is called an edge. And you've probably heard that before. Every trader has his or her edge. And more likely than not, you have multiple edges that make you a profitable trader. So let's define what an edge is. That is a statistical or behavioral advantage in the market. An edge is an advantage. It's something that makes you better than other traders who are unprofitable. It's the reason why over hundreds of trades, you're going to make more money than you lose. You have to understand that an edge, a statistical advantage, is played out not over 5 or 10 trades. It's played out over thousands of trades. And that's why it's so important to develop a sample size for your trading so you can actually extract data and then use that data to refine and build your trading plan, which, by the way, I'm going to cover all of this later on in the course. Okay, so you need to focus on building an edge, and that edge is going to make you money long term after you take hundreds and hundreds of trades. So very good. So is trading gambling? You could call it gambling because you're betting on an uncertain outcome of a future event. You don't know if prices are going to go up or down, and you're betting on that prices are going to go up by going long, or that prices are going to go down by going short. And the way you shift the probabilities in your favor is by developing an edge. So that begs the question, what types of edges even exist? And there's a bunch of different edges. Number one, technical edge. Technical edge is an edge when it comes to reading the price action, mastering the chart setups, understanding the relationship between the buyers and the sellers, understanding volume, understanding support and resistance, understanding what separates a high quality setup from a low quality setup, understanding how to calculate reward to risk so you're only picking the setups that have a high likelihood of making you money. There's also a psychological edge. This is a trader that's able to control his or her emotions. They're able to stay disciplined, and they're able to execute on their plan even when it feels uncomfortable. And this is when you're able to control yourself. You're able to also control your impulses, and you're able to consistently follow your plan without having your emotions impact you. Next, we have a risk management edge. And there's a really kind of funny expression that I've heard in trading, and you'll have to excuse my French, but most traders eat like birds and shit like elephants. And essentially what that means is a majority of traders don't make much money on their winning trades when they're right, but they lose a lot on their losing trades when they're wrong. And as a trader, you want to reverse that outcome. You want to be capitalizing heavily on the trades where you are right. On the winning trades, you want to be making a disproportionate amount of money. And then on your losing trades, you want to focus on limiting your losses. And that's the risk management edge. And I'll tell you straight up, for me, the reason I am such a good trader today, I am really good at risk management. I rarely have losing weeks. I've never had a losing month in my entire career. Of course, I have losing days, but I'm really good at limiting my losses on my losing trades, and I'm very good on capitalizing on my winners. But specifically, I'm really, really good at managing my losses. I'm a really good loser, and that's what makes me a really good trader. Now, of course, I do have the other edges as well, but I would say my risk management edge is probably the most important edge in my own trading. And a lot of the times, you could have an excellent strategy. You could be an excellent trader, but if your risk management sucks, you're never going to become profitable, right? Your first priority as a trader is to actually preserve the capital in your account. You'll learn about that later in the course. Number 4, execution edge. This is the edge where you have a really good trading plan. You are very good at reading price action. You're good at identifying high quality setups. You're good with the risk management, but you're also excellent at executing it and being able to actually make money off of your trading plan in real time. You know how to quickly execute on your platform and get out of trades really quickly, enter into trades really quickly. You're able to manage trades in real time without making emotional decisions. And it's your ability to act on your plan without hesitation. And in this course, by the time this video ends, you will know exactly how to turn every single one of these edges that I just talked about into a system. You're going to learn the specific details that you need to know to master every single one of these edges. So hopefully it can transform the way that you trade forever. And that's exactly why I created this free course, to give you an edge in your technicals, with your psychology, with your risk management, and with your execution. Let's go over the different types of markets that you could trade in 2026. And for me personally, I day trade stocks. I don't trade crypto. I don't trade Forex. I don't trade futures or options. I am day trading stocks only. And I trade small caps, mid caps, large caps. I even trade penny stocks. And I personally trade on a margin account. Now, the one thing about trading on a margin account is that the PDT rule is going to apply. And the PDT rule, the pattern day trader rule, it requires you to have at least $25,000 in your margin account if you want to take more than 3 trades per week. If you have less than $25,000 in your margin account, then you're limited to only 3 trades per week. Now, the reason why a margin account is so useful is, number one, on a margin account, I can go long and I can go short. On a cash account, which is a very common alternative, you cannot go short on a cash account. And there are also other limitations that I'm going to talk about later in this free course. And with a margin account, you also have access to 4x additional intraday buying power. What that means is, if I have $25,000 in my margin account, I could day trade with $100,000 worth of capital. If I have 30K in my account, I could trade with $120,000 worth of capital. And you might think that's really risky, or maybe you're associating the word margin with someone that you know who lost a lot of money. But margin is only risky if you don't know how to control your risk. If you just YOLO every play, you have no idea what margin is, you don't know how to size your positions, of course it's risky. If you don't know what you're doing, yeah, trading is going to be risky. Anything is going to be risky if you don't know what you're doing. You can't imagine driving a car without knowing how to drive, right? Obviously, that's going to be risky, but that's why you learn the proper precautions. You learn how to drive a car effectively, and that's when you go out on the highway, right? So same thing with trading. There are ways to minimize your risk and for you to control your risk, which is, that's exactly why you're watching free course. I'm going to teach you how to do that. Now, I personally trade on a margin account because I'm able to take more than 3 trades per week. And of course, I have way more than $25,000 in my account. However, when it comes to how much money you need to start day trading, you only need about $25,000. In fact, I would probably add a little bit just to have a buffer, because if you go below $25,000, even if it's $24,999, you'll be below the 25K and you'll be limited to 3 trades per week. So I'd recommend having maybe 25,500 in your account, or 26,000 or 27,000, just so you have a small little buffer, so you're not constantly worried that your account balance is going to fall below $25,000. I also think that day trading stocks, what I do, it's a lot easier and more straightforward to manage your risk. In fact, I think it's overall way more beginner friendly than trading options or futures or even crypto. I really think day trading stocks is the most beginner friendly, and it's the easiest to actually control your risk as long as you know what you're doing, okay? Number 2, crypto. This is when you're trading Bitcoin or altcoins such as Ethereum, Solana, or other coins. With crypto, you could use actually an insane amount of leverage. There are some platforms that allow you to trade with up to 200x leverage, which is just insane. I don't really recommend day trading crypto. I think it's way better for swing trading. Now, the thing is, with crypto, it's a 24-hour market. And what I don't like about trading in a 24-hour market is that I really like that as a day trader, the stock market closes at 4 p.m. Eastern, meaning once 4 p.m. hits, the market's closed, I can't trade anymore. And I like that. I like, once 4 p.m. hits, I'm out of all my positions as a day trader. I don't have to worry about overnight risk. I don't have to worry about, where's my stock opening at the next morning? Am I up or am I down? I don't worry about that. 4 p.m. hits, I'm done with the day, and I don't think about trading unless I'm journaling or reviewing my trades until the next morning, which I like that. With crypto, it's a 24/7 market, so you might be waking up in the middle of the night and checking on your positions and just constantly being stressed because there's crazy fluctuations in the crypto markets. I don't like that, okay? I like trading in a market that closes at 4 p.m. Eastern, okay? However, there's a lot of volatility in crypto. A lot of traders do like that. What I don't like about crypto as well is that during slower times, like during bear markets or when the market's not doing anything, or when Bitcoin is just chopping around, right? Volume can kind of dry up and it can be pretty slow. So yeah, crypto is a whole nother animal. I personally like day trading stocks, but I do invest in crypto. I'm a big, big believer in Bitcoin and Ethereum long term. Next, futures. I'll be honest with you guys, I don't have a lot of futures experience, but that's like trading NQ, ES, oil, gold, and other leveraged instruments. It's very prop firm heavy. A lot of people who trade futures use prop firms, which I'm also going to cover in this course. And I think trading futures, it's easier to scale your profits once you're really good at trading futures. However, there's a lot more of a learning curve to get started, because I think it's a lot harder to manage your risk with futures compared to day trading stocks. And that's why I recommend for most beginners to just start with stocks, and later on you can move on to futures. And yeah, I think I don't have much experience with it, so you could still apply a lot of my education that I teach in this course towards futures. I just don't personally trade it. Forex, never traded Forex, never will. I think it's a really heavily manipulated market. I just don't recommend trading Forex. Why would you trade Forex when you could trade, stocks or futures or crypto? Just stick to those. Personally, I day trade stocks, but it doesn't matter. You could apply everything that I teach in this video towards all markets. So if you want to use my education for futures, great, you can do that. You want to use it for crypto, great, you could do that. For stocks, fantastic, that's exactly what I trade. Even if you want to trade Forex, no problem. You could still use all of these principles and fundamentals and price action concepts that I'm going to teach for your trading. Let's go over the tools, software, platforms that you need in order to trade. And I actually have personal experience with a lot of the platforms I'm going to talk about, so I'm going to give you my honest opinion. Number one on my ranking is Thinkorswim by Charles Schwab. This is actually the platform that I personally use for my own day trading. And whenever you're creating a Schwab account, make sure you enable margin and you enable Thinkorswim access when you are applying. And let's go over the pros first. Number one, the execution is overall really good. It's a great platform to scalp stocks on. Of course, every platform is going to have delays and it's going to be slow from time to time, but overall, Thinkorswim is consistently fast with the execution. And I think the platform overall is actually pretty intuitive at first. It's going to seem really strange because it looks a lot different than other trading platforms. However, once you get the hang of it, it's super intuitive. I really like the charting. It's great for shorting, has a really good hard to borrow list, and the hard to borrow fees aren't too expensive. So you have a lot of different options when it comes to shorting stocks. And it's available internationally, right? It's available almost everywhere around the world. In Europe, it's available in South America, it's available in certain parts of Asia, it's available in certain parts of the Middle East. So if you're watching this and you're not from the United States, I would just do a simple Google search, look up, is Schwab available in my country? And if it is, go to the Schwab International site and you should be able to find your country and you'll be able to apply for an account. And overall, I love using Thinkorswim. Another huge pro is they have excellent price improvement, and that's when they give you a better fill than you were supposed to get on your trades, which could be a massive edge on some of your trades. So the price improvement is excellent as well. I would say the biggest con is the fact that the paper trading platform has limitations. So if you're a beginner and you don't want to jump into real money right away, you want to paper trade first, the paper trading platform honestly kind of sucks. There's huge delays. The execution isn't good. The fills aren't good. So that's the one con, I would say. Funny enough, all those delays that exist with paper trading, they don't exist with real money. And in fact, it could even be looked at as a pro, because I've actually had students that paper traded on Thinkorswim for a few months. They became profitable paper trading. And once they transitioned into real money, they actually performed even better with real money, because paper trading on Thinkorswim is almost like trading on hard mode. It's like playing Mario Kart on max difficulty, where it's super, super hard, right? But then once you go to real trading and you don't have those same delays and you actually have really good execution and good fills, trading feels a lot easier. So it's kind of actually a good thing where you can kind of trade on hard mode as a beginner. And then when you go to trading with real money, it feels a lot easier execution wise. So I highly recommend Thinkorswim. I don't even have an affiliate link. I'm just recommending what I personally use. Next is TradeStation. I used to use TradeStation back in the day. TradeStation is solid. I would say it's just a worse version of Thinkorswim. The execution is actually great. The platform can be a little bit glitchy when it comes to charting, but overall, it's actually really similar to Thinkorswim. It's a great platform. The biggest con for me personally is the fact that the short list is limited. You can't short as many stocks on TradeStation as you can on Thinkorswim, and locating shares can be super annoying. So if you're choosing between TradeStation or Thinkorswim, I would just use Thinkorswim personally. Now let's go over Webull. I've never used Webull actually. However, I've had students that have used Webull. It's a pretty good platform execution-wise, but similar to TradeStation, the short list is limited. I don't think they really have that good of price improvement, and the customer service is non-existent. Okay, so if you're stuck in a trade and you want to call their front desk, no one's going to pick up. Yeah, the customer service just isn't good. So between Webull, TradeStation, and Thinkorswim, I would obviously use Thinkorswim, but Webull is still a solid option. Interactive Brokers, it has commissions. So if you're in a country where no other, you don't have access to any of these other platforms, and Interactive Brokers is fine. However, it has commissions, and I know the platform isn't very intuitive. Next, we have Lightspeed, and there's a bunch of platforms similar to Lightspeed, also like Cobra Trading. And the only issue with Lightspeed is that they have big commissions, but the execution on Lightspeed is amazing. So the execution is amazing. And I think it's actually pretty complicated for a new trader. That's another con. And you could also customize your routing on Lightspeed. So I would say if you're a trader who's trading massive size, where you don't really care about paying 500 to 2,000 a day in commissions, you're trading massive size, you're going for 20, 30, 40, 50K days, Lightspeed is probably your best option. However, the commissions are super rough, but the execution is excellent. So that's what I would recommend. Personally, I would just go with Thinkorswim platform out of all of these. And if you're international, I think you could actually pair Interactive Brokers with TradeStation if you don't have Thinkorswim available in your country. And if you're a beginner, or unless you're trading massive size, I just wouldn't use Lightspeed, right? Because the commissions are just overwhelming. Other tools, you could use TradingView.com. You don't need to purchase a paid account. I use the free account. I don't use this for my personal day trading. I use this after trading hours if I want to review charts. I use this to look at crypto. I use this on my phone whenever I want to check out a chart. It's a really easy charting software. I don't think there's a need to pay for premium though. You could also use a trading journaling software where you could actually link the platform where you execute your trades to this software, and your trades would actually carry over, and the software would give you feedback based off your win rate or your reward to risk, and it can give you very valuable information about your trading. So it can be super useful. The most popular one is TradeZella. Now, I don't personally use one right now. However, I've had a lot of students that have used TradeZella and other ones, and they found it really beneficial for their trading. I would just do a Google search and look up best trading journaling softwares, and from there just pick the one that makes the most amount of sense for you. And when it comes to actual trading setup, my biggest recommendation is to just keep it simple. Now, you can trade on a laptop, that's fine. When I started, I actually traded on a small little Dell laptop. However, I do recommend a 25-inch plus monitor just so you do have the screen space. And I'd recommend either a desktop computer, or you could actually link your laptop to the monitor. You need a mouse and a keyboard, and of course you need a great Wi-Fi connection. That's all you really need, okay? There are a lot of traders that have like crazy curved screens. They have 5 different monitors, and it looks like a really complicated and professional and fancy setup. You don't need that, okay, especially as a beginner. If you have a 25-inch monitor, a normal computer, and a good Wi-Fi connection, and a mouse and a keyboard, that is all you need. Start small, and then you could upgrade your setup as you become more profitable. Let's talk about order types and order execution. Whenever you are placing a trade, you need to submit an order. And the best way to think about this is the orders that you place is kind of like the language between you and your trading platform. And you're going to be placing different types of orders depending on the trade and depending on what you want to accomplish. So you're going to be placing different orders if you're going long or short, or whether you want to buy at a certain price or exit at a certain price. And it's really important to master the language between you and your trading platform so you could trade quickly and you could trade efficiently. So let's go ahead and talk about all of these types of orders so you can become a master and you could really understand the types of orders that you want to execute. So let's go and start with a market order. And this is probably the most basic type of order. And by definition, a market order buys or sells a stock immediately at the best available price. So if you're trading on your platform and you press market buy, you are going to get filled right away at the best available price. If you're in it long, let's say you're in a position, it's long, it's moving up, and you want to sell that position as quickly as possible, you would place a sell market order and it would fill your position at the best price available, the current price. So this is an order that you would use if you want to get out as quick as possible. You want to exit right now, you would place a market order to sell if you're long, or you would place a market order to cover your shares if you're in it short. So let's say, for example, Apple is trading at $180 and you place a market buy order. That order is going to fill you right away. However, it's not going to fill you at your desired price. It's not going to fill you, or it's not guaranteed to fill you at your desired price. Meaning, let's say the price is at 180, you press a market order to buy. Maybe by the time your order executes, the price moves and it'll fill you either at 180.02, or maybe if it's really moving fast, it's going to fill you way late and it's going to fill you at 180.20. Or maybe it'll fill you, below that price where it fills you at 179.98 or 179.90. And that is really going to depend on how quickly the stock is moving. It's going to depend on the spread, which you're going to learn about later. It's also going to depend on the liquidity. So this is like saying, I'll pay whatever the current price is, just get me in right now or get me out right now. Okay, so what does a market order really mean? So you're going to get really fast execution because it's going to fill you immediately, whether you're getting in or whether you're getting out. However, it's not guaranteed to give you the best price. For example, let's say Apple is moving up and it's starting to consolidate. And let's say I want to buy it when it hits 180, like this example, right? And let's say as soon as it hits 180, that's your trigger to buy it, and you place a market order to go long, right? By the time your order executes, maybe the stock has already moved really quickly and it's here by this point where it really moved up, and you place an order at 180, market order to buy, but it ends up filling you at, let's say, 180.30, right? That could happen where you get filled 30 cents late than when you actually placed the order. And of course, that's going to depend on liquidity, it's going to depend on the spread, and it's going to depend on how quickly the stock is moving. So that's the downside. You're not always going to get the best price. You can't control the price that you get filled at because it's just going to fill you at the best available price, right? So for me personally, I rarely use market orders to enter into trades. Pretty rare. I would say maybe 5% of the time I'm going to enter into a trade using a market order. However, I always use market orders to exit my trades, right? Even if it's a stop loss, right? A stop loss order actually triggers and executes like a market order, and I'm going to explain that in a second. But whenever I'm exiting, I'm always using a market order to exit. I rarely use market orders to get in because whenever I'm entering into a trade, I want to make sure I get my desired price. I don't want to get in late, okay? Because if I get in late, let's say I want to get in at 180, I place a market order right here, and it fills me at 180.30, well, I'm 30 cents late. That's going to impact the size of my stop loss, which you will learn about later in this free course. And it's also going to impact my reward to risk, which you will also learn later. So, Yeah, when it comes to market orders, I don't like to use them to get into trades. However, I always use them to exit out of trades, and it's going to fill you at the best available price. However, you're not guaranteed to get the exact price that you want. So this is more for instant execution. Let's go over what a limit order is. A limit order lets you set the maximum price you're willing to pay when it comes to going long, or the minimum price you're willing to sell when you're going short or when you are selling. So the best way to explain this is to go over an example. So let's say you want to buy Tesla at $240. However, the current price is $245. So let's say Tesla is basing, and right here, it's $245. Okay, great. However, you think that's a little bit too expensive. You don't want to pay $245 for your shares of Tesla. You want to pay $240 or less, right? You don't want to pay anything more than $240. So you're okay with paying $240. You're okay with paying $235 for Tesla. You're okay with paying $200 for Tesla. You just don't want it to be more than $240. Great. In this example, you would set a limit order at $240. So you'd place a limit order right here, let's say, at $240. So $240, you place a limit buy. Okay, I'll just write limit buy. Fantastic. So now the only way that you would get filled on your limit buy order is if the prices went down to either 240 or below 240, where maybe let's say Tesla reported earnings and the earnings weren't very good at all, and the stock gapped down overnight, had an overnight change in price to the downside and opened lower the next day. Let's say it opened lower at 230, right? Would it fill your order? Well, is 230 less than 240? Is it a better price than 240? Yes, it is. 230 is less than 240. It's a better price. So therefore, you would get filled, right? If it gapped to 220, would you get filled? Well, 220 is less than 240. You placed a limit buy 240, so you want to pay 240 or better. 220 is better than 240. Yes, you'd get filled. Let's say it opened instead at 242. Would you get filled? Would you? And the answer is no, you wouldn't, because you only want to buy this at 240 or lower, 240 or better. So you will not get filled. So you get filled at 240, yes, 230, yes, 220, yes, right? And you know, the downside is, right, you control the price, you control exactly where you want to get in. However, you might not get filled, right? Maybe the prices don't go down to 240 and instead the prices just continue going higher. In that case, you're not in the trade, right? So this is like telling your broker, I want you to buy these shares, I want you to buy this stock, but only if it gets cheap enough, okay? And the same thing applies if it's the opposite way and you're going short. It's the same exact thing, okay? So when it comes to limit orders, I actually use limit orders 95% of the time when I'm entering my trades. And I place limit orders on the current ask price when going long, and I place sell limit orders on the current bid price when going short. So there's probably going to be a video later on in this free course that really explains the bid and the ask. But basically, you know, when it comes to trading, it's basically kind of like an auction. You have a bid and you have the ask, right? The ask is the best price the sellers are willing to sell at, and the bid is the best price the buyers are willing to buy at, right? So for example, let's say the bid is at $7 and the ask is at $7.01. So right off the bat, the difference between the bid and the ask is called the spread. So $7.01 minus $7 is 1 cent. That means there's 1 cent spread here. That still sounds confusing. Don't worry, I'm going to cover it later in this free course, okay? So if I want to buy a stock, I'm going to get filled where? Well, who am I buying from? I'm buying from the sellers. And the sellers, well, their price is at $7.01. The sellers are willing to sell this stock at $7.01. So when I'm buying, I'm going to get filled on the ask. I'm going to get filled on the ask price. Whenever I'm selling, well, who am I selling to? I'm selling to the buyers on the bid. So if I sell something, I'm going to get filled on the bid at $7. So for example, let's say I buy a thousand shares of stock, right, at this current price. Well, I'm going to get filled for where? I'm going to get filled on the ask. So I buy 1,000 shares. I'm going to get filled at 701 when I'm going long. Okay. Now, if I was to sell immediately, let's say the price doesn't move and I just sell this immediately. Well, if I sell, I'm going to get filled on the bid, right? So now I'm selling 1,000 and I'm going to get filled at 701. Oh, I'm sorry. I'm going to get filled at $7. $7, not 701. I got filled at 701 when I bought it, and then when I'm selling it, I get filled on the bid, so I get filled at $7. So how much am I losing here? Well, right off the bat, I'm losing 1 cent, right? Because $7.01, when I got in long, I got filled on the ask. When I sold it, I got filled on the bid, so I lost 1 cent in this trade, right? 1 cent on 1,000 shares is $10. So that means by just me getting into this stock and without it moving, I'm automatically down $10. I'm automatically down 1 cent on every single share that I bought. Coincidentally, 1 cent is also the spread. And that's exactly why spread is significant. That's why we want to trade stocks that have tight spread, right? Because if I'm buying, let's say, something that's super spready, let's say instead this is at 707, this is at $7, right? So the bid is at $7. It's the best price the buyers are willing to buy at, but the ask is at 707. This is the best price the sellers are willing to sell at. That means, what's the spread? Well, 707 minus $7 is 7 cent spread, because that's the difference between the bid and the offer. That means if I was to buy this stock, where would I get filled? 1,000 shares, I want to buy it. I would get filled on the offer. So I'd get filled at 707. And then let's say the price doesn't move and I want to sell it. Okay, I sell 1,000. Where would I get filled? At $7. So how much did I lose here? I lost 7 cents per share. How many shares did I buy? 1,000. So I would lose $70. So basically the spread is significant because that's the exact amount that you're down whenever you enter into a trade without it moving, right? Like if you enter into a trade, right away you're down whatever the spread is. You're down 1 cent times how many shares you have. Or in this case, down 7 cents because the spread is 7 cents. Does that make sense? So that's actually a little bit of a crash course when it comes to spread. It's not really important yet. You don't need to know that yet, but just so you have some background, let me go ahead and erase this. So let me explain how I place my limit orders. Okay, let me just erase all this. Okay. So when it comes to placing my limit orders, and I'm looking, and by the way, you would use the level 2 to see the bid and the ask, but most platforms are going to tell you this. So again, this is the bid, this is the ask, okay? So if I get in, let's say the bid is at $7 again, and the offer is at 701. When I buy it, where am I going to get filled? I'm going to get filled on the ask. So what I will do whenever I'm getting in is I place a buy limit order on the current ask price. So if I want to buy this right now and I don't want to pay more than 701, I will place a buy limit order at 701. Okay? And whenever I want to sell, I can either go market, right, which is I'll just get out immediately at the best price available, or I could place a sell limit order on the bid. So whenever I'm buying on the ask. Whenever I'm selling on the bid. So that's what I would do, right? So if I'm going short, I want you to think about it. If I'm going short, what kind of order am I going to place? Well, I'm going to be placing a sell limit order where? A sell limit order on the bid, okay? In that case, I'm paying this price or better. So if the price goes down, I'm not going to get filled late, right? Or let's say I place a buy limit order. Where am I going to place that? On the ask. I'll place it at 701. In that case, if prices jump to 702 or 703 or 704, I'm not going to get filled late because it's a limit order. I'm only willing to pay that or lower. So if I place a limit order at 701, that means I only want to get filled at 701 or better. So I can get filled at 701 at $7 or $6.99, right? But I'm not going to get filled at 702. And that's what ensures I won't get filled late. So that's exactly why I place buy limit orders on the current ask, or whenever I'm going short, I will place a sell limit order on the current bid. Now, that honestly might sound a little bit confusing, especially if you're a beginner. Don't worry. That's fine, okay? If this still sounds confusing, don't worry. I'm going to cover it later in this free course. But that was basically a crash course on how the bid and the ask works and how spread works and how I place my orders. I place buy limit orders on whatever the current offer is to make sure I get filled here or better and I don't get filled late. Whenever I'm going short, I place sell limit orders on the bid price, and that ensures I either get filled at $7 or better and I don't get filled late if the price continues to drop, okay? Hopefully that makes sense, and my recommendation is to just practice this, okay? And let me know in the comments if you do have any more questions about this. Happy to clarify anything. Fantastic. Let's go ahead and talk about what a stop order is, and you've probably heard of this because I'm sure you've heard of stop loss. Well, a stop loss order is a stop order, okay? So by definition, a stop order becomes a market order once the price hits your stop level. Most people use this to protect themselves from big losses. So hypothetically, you bought NVIDIA at $120, okay? NVIDIA triggers a breakout and you bought it at 120 right here. And you set a stop order at 115. Let's say your stop order is at 115 right here. And this is a sell stop order, okay? If the price drops to 115, it will trigger a market order to sell your shares. That's really important. So let's say that again. If the price drops to 115, that means the price drops to 115, it will trigger a market order to sell your shares. So it will exit you as soon as your stop order is hit when prices hit 115. Now, keep in mind, because it will trigger as a market order, it's not guaranteed to fill you at exactly 115. It might fill you at 115. It might also fill you at 114.80 or 114.90 or 115.10 or 115.15, right? Because it's a market order. We already talked about that a market order gets you out at the best available price. And we already talked about that. If it's an illiquid stock, or if there's a lot of spread, or if it's a really fast moving stock, it might not fill you at the exact price where you placed your order, okay? So if you place a stop order at 115 and it triggers, it might not actually fill you at 115. It will fill you at whatever the best available price is when the order executes, which could be 114.90, it could be 114.60, it could be 115.10, right? It completely depends, okay? So let's go over another example. You could also place stop orders when you want to enter into a trade. So let's say NVIDIA is at $120. Okay, let's erase this example. Let's say NVIDIA is already at $120 right here. Okay, but you want to enter the trade if the price hits 130. Meaning, let's say it's at 120. You don't want to get in at 120. You want to get in at 130 right here, because let's say, I don't know, if it hits 130, it officially triggers a weekly setup. And there's a breakout on the weekly time frame. You only want to get in if prices hit 130. So what you can do is you place a buy stop order at 130, and this will only trigger if prices move up and hit 130. Okay? So you could place, stop orders when it comes to protecting yourself where you're in it long and you place a stop loss order wherever your stop loss is, or maybe you're in it short. Maybe it's a breakdown, right? You get in right here at 120, and let's say your stop loss is at 130, hypothetically, you would place a stop loss at 130, and then if prices go back up to 130, it would exit you out of your position, okay? So you could either do it to exit your trades, or you could even do it to enter into your trades where, like in this example, prices are at 120, but you only want to get in if prices hit 130. So you would place a buy stop order at 130, and it would only execute once prices move from 120 to 130. So this could help you limit losses, but it may execute slightly below your stop due to volatility, right? We just talked about that, how because it's a market order, you're not guaranteed to get filled at the exact price that you want, right? And same thing with this. If you place a buy stop order at 130 and prices move up and hit 130, it might not fill you at 130. It might fill you at 129.50. It might fill you at 130.30, right? Again, depending on how fast the stock is moving. So this allows you to place orders ahead of time if price hits a certain level, right? So if prices go to 130, it'll fill my order and it'll trigger me into the trade. Or let's say it's a short, right? Let's say this is 100. You only want to get in if prices hit 90, right? In that case, you'd place a sell stop order at 90, and then prices need to go down to 90 to fill your order, and you would get executed here as a market order, okay? So you could use stop orders either to exit out of trades by using just a traditional stop loss order, like probably what you've heard of, that we just showed, where you're in a trade, you place a stop loss. If it hits your stop, you're out of the trade to protect yourself from further downside. Or you could even use it to enter into trades where you want prices to move up to a certain key level to get filled, or if you're in it short, you want prices to drop to a certain key level before you get in the trade short. So hopefully that makes sense. And yeah, make sure you rewatch this clip and the other clip, the limit order, a couple of times to really understand what this means. And my suggestion is to go and practice this. Open up your platform and start taking stop order trades and start taking limit trades as well, just to get a feel of it and just to get some practice in. Let's go ahead and talk about what a stop limit order is. And just like the name suggests, a stop limit order combines a stop order and a limit order. So once your stop price is reached, instead of it triggering as a market order like I talked about in the last example, instead it triggers as a limit order. So instead of a market order, it triggers as a limit order. So let me explain why this is important and how it works. So let's say you're watching NVIDIA at $120. You've identified a resistance level at 125. Price has tested it multiple times, but it hasn't broken through yet, okay? So let's say you're looking at NVIDIA, you see a consolidation, and the current price is $120. And this key resistance level is right here at, let's say, 125. Fantastic. You strongly believe that if it breaks over 125, it could rally quickly to 130. So let's say this is your target at 130. You're confident that if prices break 125 and it breaks out of this resistance area, it could easily go to 130. Great. So what you can do to execute on this order is you could place a buy stop limit order. Okay, so your stop price would be 125, right? Just like in the other example that we just went over when we went over what a stop order is, you could place your stop order at 125, right? So meaning if prices go up to 125, it would trigger your stop order and you would get into the trade. Now, a traditional stop order, that order would trigger and execute as a market order, meaning you might get filled at 125. You also might get filled at 125.10 or 125.30 or 125.70 or even 126. It might fill you late because this stop order is triggering like a market order, right? Maybe it fills you even below. Who knows? It depends how the stock moves. But the point is, you're not going to get your exact price at 125. You might get above your exact price or below your exact price. And that uncertainty is unsettling for a lot of traders. Who knows? Maybe the stock moves really quickly, right? It hits your stop order at 125, triggers a market order, and it fills you at 127, right? It fills you at 127. And now you're in the trade $2 late, and you don't like that. So what you can do to protect yourself from that situation is, instead of using a stop order, you would be using a stop limit order. So when you add the limit part of this into the equation, right, what you could do is you place your stop price at 125. Great. So when prices hit 125, great. Instead of it triggering a market order, it would trigger a limit order, and you could do a buy limit order at 125.50. So let's say that happens. Let's say you place an order, a stop order at 125, and when the stop is hit, then the limit order activates at 125.50. So keep in mind, what does a limit order do? Let's go ahead and remind ourselves what a limit order does. A limit order sets the maximum price you're willing to pay when you're buying. it sets the maximum price. So basically, with this limit order triggering at 125.50, it's either going to fill you at 125.50 or lower, meaning that let's say the stock moves really fast, and by the time this triggers, it pops really fast to 125.70 or 126 or 127. It's not going to fill you up there. It's not going to fill you late. It's only going to fill you at 125.50 or lower, okay? So if NVIDIA's price hits 125, your buy stop triggers, your limit order activates, right? So your buy stop would trigger, and as soon as that's triggered, it would activate your limit order. And you will only get filled if the price is at 125.50 or lower. You will not get filled if the price spikes too fast and too high. You won't get filled at 126 or 127. You're only going to get filled at 125.50 or lower. It's like me saying, if the stock proves itself and breaks above resistance, right? If it breaks above 125, I want to get in. However, I only want to get in if I can get a reasonable fill. I only want to get in if it fills me at a reasonable price. And you could set what that reasonable price is. You could set this instead of 125.50, you could set this at 125.10, right? In that case, if this triggers, your limit order activates, right? You're only going to get filled at either 125.10 or better. You won't get filled late. Now, the downside is maybe it's fast. Maybe it goes up right away and it doesn't even, it just flies by your limit order. In that case, you won't get filled. However, at least you're not in it late versus, if you used a regular stop order, it would fill you market and you might be super late on the trade. Okay, does that make sense? So in summary, I know that might be a little bit confusing. In summary, whenever you're placing this type of, stop limit order, it's always going to ask you, what's your stop price? Like on your platform, it's always going to ask you, what's your stop price and what's your limit price? Okay? So you have to put in the stop price first. In this case, I want to potentially get in if it breaks above this resistance, right? If it breaks above 125, that's the trigger for my setup. I want to get in. So your stop price would be 125. However, I don't want to pay 126 for this. I don't want to pay 127. I don't want to get in late at 128. I want to make sure that if it hits my stop at 125, right, I want to make sure that my average price is no greater than 125.50. I'm okay with being 20 cents late, 30 cents late, even 50 cents late. However, I'm not okay with being even 60 cents late, which would be at 125.60. I'm not okay with being $1 late, which would be at 126. No, I want to get filled at 125.50 or better. And this allows you to control the price that you get filled at. So it's a really useful way to make sure that if you're getting into a trade using a stop order, well, you're not going to get filled super late when it ends up triggering as a market order. You could place a stop limit order and you'll get filled, you make sure you won't get filled at too high of a price. Okay, I don't recommend doing this when it comes to exiting a trade, right? Like let's say you're already in a position, let's say you're in this breakout long, I don't recommend placing a stop limit order here, right? Because if you're exiting a trade, you want to get in, you want to get out as soon as possible. You don't want to, like imagine you leave your desk and you have a stop limit order here, who knows, it might not fill you. And all of a sudden you're in the trade as it's going against you. So when it comes to exiting, I would just use a regular stop order where it'll just fill you market at whatever the price is. But whenever you're entering, you also have the option of using a stop limit order to make sure you control the price that you get filled at. Okay, hopefully that makes sense. And my recommendation, guys, is based off my explanation here, I would load up your trading platform. I would rewatch every single one of these explanations. And as I'm explaining it, I would literally, do what I am explaining. I would literally go on your platform and place these types of orders. You could do it on maybe on a simulation with paper trading, so you're not risking real money. And you could practice and you could see how it all plays out in real time. That's my suggestion. So do that, and yeah, I'll see you in the next video. Let's go over some key trading terms, and to make this as convenient as possible for you, I actually uploaded all of these terms onto a Word document, and you can download this document in my free course community. So if you go to the description of this video, you click on the link to join my free community, and you go into the free course, the same one that you're watching right now, you could actually go to the key trading terms video, and right under that video, you will be able to find this PDF document, and you'll be able to download it or even print it. So make sure you join up in my free course community, because I'm going to be posting way more resources for you, such as other PDFs and frameworks that you can download and print out that will really help your trading. I also do bi-weekly live trainings that you can sign up for, of course, as well in my free community. So that's probably the easiest way for you to review this and for you to refer back to it. So download that file, and I'll see you on the next video.
Hey guys, the topic for today's class is the differences between technical and fundamental analysis. And we're still super early on in the course, so I figured it'd be very important to actually touch up on technical analysis and fundamental analysis. And if you guys haven't heard of those terms, these are the terms that describe how to analyze a particular security. It mostly applies for, stocks, and it does also apply for crypto, but I think it was coined mostly for stocks, right? And, I'm sure you've probably heard one is superior to the other. So I'm here going to tell you exactly what they are, what to focus on, and how you can begin using them, okay? So let's start out with technical analysis. Technical analysis is focusing on reading price action, okay? That's what we're focused on. Reading historical price trends and price action in order to determine whether we're going to go long or short, or determine our outlook on the stock for whether it's, during the intraday time frame, whether it's, few hours, few minutes, or even, few days, even few weeks, few months away. Okay, so the two buzzwords, or the two buzz terms, are price action and price trends. Okay, and technical analysis for trading, specifically for trading, and that's what this course is about. We're here to learn about trading. Technical analysis is the only way to analyze a stock for the short term, right? Because as traders, we're operating kind of on a short-term basis. Even if we're approaching longer-term trades, trades that are, several months or, several weeks, that's still short-term enough where you're going to be using technical analysis, okay? If you're looking, 10 years out, 5 years out, trying to figure out the value of a stock, of course, then we're going to use fundamental. But I'm gonna get into fundamental analysis in a second here. I just want to finish up with technical analysis. So the whole point, the whole goal of this course is to actually teach you guys technical analysis, and that's only one part of trading, but it's one of the most important parts, because ultimately that's how we're going to predict, price action is by reading prior price action, the way the candlesticks look, the way the moving averages look. We're reading all of this to make intelligent decisions on where to put our money and what trades to actually take, okay? And that's why technical analysis is king. If you guys aspire to be successful traders, you must innately understand technical analysis. And this is what you should be focusing on, technical analysis, not, and we're going to get into it now, fundamental analysis. Fundamental analysis is basically looking and reading the intrinsic value of a security, of a stock, of a crypto, the intrinsic value. So you're going to be looking at, macroeconomic trends. You're going to be looking at financial statements of the company. You're going to be looking at intellectual property. You're going to be trying to read the company's worth, right? And based off, how valuable the company is, what they offer, whether, the products are trending, for a longer term scale, or, just reading the actual value of the company, we're able to establish, if this is a good investment. But this is, what you have to understand, fundamental analysis is, for the longer term, it's for 5, 10, 15, 20, 25 years down the road, right? We can't read, we can't read shorter term trends using fundamental analysis. Okay, so for our purposes here, for purposes of trading, and actually before I get into that, I just want to give you guys a quick example. The reason why a lot of people, unsuccessful traders, a huge reason is because they actually pay attention to news, which at the end of the day, news about a company, news about a crypto. At the end of the day, that's fundamental information. That's not technical information, right? That's not about price action. It's about something the company did, something the company acquired, right? Certain news going on around the company. People focus on that and they actually enter trades just based off the news, just based off recently heard fundamental information. And this is one of the biggest mistakes you can make. Why would you, buy something when, you're hearing about the news the last? We're the public. We hear about the news literally last. Think about all of the, shareholders or people, insiders in the company. They heard about this news weeks ago, months ago. The news that you're hearing on a day-to-day basis about stocks, companies, crypto, it's already priced into it. Okay, so stop relying on that information. Sorry for this tangent, but it's extremely important. Stop relying on this information. Okay, it is pointless. It will only lead to, bias in your trading and a complete lack of objectivity. Okay, and that's why, in order to have objectivity in trading, we have to read the price action. We have to read what the charts say, and the charts, like this one here, shows you price action. Okay, and those are the main differences. So key points here is focus on technical analysis, and you don't really need fundamental analysis for trading at all. I mean, I'll tell you the truth. I have never researched a company in my life that I'm trading. It doesn't matter to me, right? I've never looked at news. The only news that could be interesting is, like, let's say the Fed is having a meeting that could be impactful, or looking at news that could affect stocks, during the intraday time frames, meaning like during the day, let's say some news comes out and a stock drops super hard. That might be interesting to you for a potential trade. But besides that, you guys should not be focusing on news or fundamental analysis. Divert, all of your attention towards technical analysis, reading price action. Okay, and that's what we're going to be teaching now. So I hope you guys found this helpful. Okay, hope you guys understand the differences and which ones to really focus on. And let's get on to the next video in the course.
Real quick, I believe in transparency, and I would never make a claim that I make money with trading without showing concrete proof. So this is my Charles Schwab brokerage account. I day trade on Think or Swim, and over the last 1 year, from October 4th of 2024 to October 3rd of 2025, I've been able to generate $529,000 in day trading profits, which is a cumulative rate of return of over 340% on my entire trading account. And some people may think this is Photoshop or this is some sort of screenshot that I edited. Well, if I go ahead and refresh the page on my Charles Schwab brokerage login and I go back to 1 year, as you can see, there's the $529,000. And the reason I'm showing you this is to be real and as transparent as possible. So in this video, I'm going to show you the exact process that I follow to become a profitable trader. And a lot of what I'm about to teach you, my dad taught me 5 years ago. And it's honestly the reason I'm a profitable trader today. I'm not showing you easy strategies. I'm not going to show you plug and play indicators that lead to easy money and, oh, use this support and resistance structure to find entries. No, I want to show you the no bullshit process that you could follow right now to actually make this happen, so you could hopefully become a full-time trader by the end of the process. And the first step is critical. The first step is important. Focus on your education, okay? A lot of people, a lot of traders, they just want to jump into the markets, fund their account, and instantly make money. That's not how it works. And in fact, in all areas of our life and every other profession out there, you need to educate yourself first. You have to go to school, for example, if you want to become an engineer or a lawyer or a doctor. You basically have to get a degree for any job out there, right? You have to go to school for 4 years to educate yourself. Yet, most traders, especially beginners, they don't want to focus on the education. They just want to make quick money. Well, that's not how trading works. And when you're focusing on your trading education, you want to focus on one core methodology. You don't want to be bouncing from this strategy to this strategy and try this methodology out, then that one, then this one, right? You want to stick with one, because every single methodology, it's going to teach different principles, and it's honestly going to confuse you. And I see this all the time where traders, they just bounce around from one thing to another, and they never stick and master just one strategy or one methodology, right? You want to build the foundation for your trading success. And if you think of a skyscraper that is being built, the engineers, the architects, the project managers, they all focus on building the foundation first. In fact, they spend most of the time working on the foundation, because the foundation is what ensures that building doesn't collapse 3 or 5 or 10 years later because of a crazy storm. And that's the way I want you to think about your trading. Just like how the foundation of a building is built strongly, so that building obviously doesn't collapse later on, that's how you need to approach your trading. You have to focus on building the foundation. So what goes into that? Well, number one, your edge. What is your edge, right? In your trading system, what's going to differentiate you from every single other trader out there? And the only way to develop an edge is to educate yourself. Focus on the education. It's your mindset, right? Are you going to approach trading with a conservative mindset or an aggressive mindset? How are you structuring your expectations when you go into trading? Of course, price action principles. How are you reading charts? Are you using any indicators? If so, how many, right? Which price action principles are you looking for in a setup, or rules within your plan, right? I think you're only as profitable as how strict your rules are within your plan. And that's part of the reason why I'm a profitable trader today, is because I'm very disciplined with the constraints within my plan. I don't deviate from my system. Of course, trade management, right? When you enter into the trade, where are you taking profits? Are you moving your stop loss? Are you taking half profits and leaving a runner? Or are you taking full profits at target one, right? Entering into a trade is the first step. The second step is extracting profit from that trade. You need a game plan for that. And of course, risk management, which, by the way, I probably should have started out with this one. This one is by far the most important. In fact, most of your foundation is going to be built around risk management and limiting your losses. Listen, I know you're excited. I know you want to fund your account. You want to start making money. However, I emphasize, please focus on your education. Focus on building this foundation for your trading, because your goal isn't to just make money over the next few months. Your goal is to make money in 5 years, in 10 years with your trading. And the only way to ensure long-term profitability is to build this foundation for success and focus on the education. And if you don't know where to go for this, I have hundreds of hours of free education on the internet, not only on this YouTube channel that you're watching right now. So I strongly encourage you to watch my other videos on this channel, but I also have a free 10+ hour trading course that is genuinely better than most paid courses on the internet. It will help you build this foundation. So you could find my free course in the description of this video. Take advantage. Let's move to step number 2. Now that you've educated yourself, you know a few strategies, you know how to calculate risk and size your positions, you know how to limit losses, you know what criteria you're looking for in your setups, and you have a methodology. From there, you're probably excited. You're ready to practice and you're ready to apply what you just learned. And this is by far the most important step. It's the application, right? You can read books, watch videos on how to drive a car, but until you're behind the wheel and driving every single day, you're never going to become a confident driver. Like, imagine you're on the highway for the first time. Are you going to feel comfortable merging? Are you going to feel comfortable going fast? No, of course not. You need repetition. You need practice. And the most important part of this step, and this is where most traders actually, they get this wrong, is when you start practicing, you either want to paper trade, which is trading with fake money, or you want to be trading with very small risk. What most traders do is that once they've learned the education, great, they fund their account and they start using big risk. And when you're using big risk during this experimentation phase where you're testing your strategies, you're testing setups, right? You're not going to become profitable right away. You're going to make mistakes. You have to figure out what works for you. You have to figure out what doesn't work for you. So why would you risk a lot of money in this beginning stage of learning, right? When you begin live trading, you need to paper trade or trade with small risk. When I say small risk, I'm talking like $1 to $5 a trade, $1 to $10 a trade. Something so small, so even if you have 10 losers in a row and you're risking $5 a trade, okay, you lost $50. That's not a big deal. That's not so bad. You're gonna learn a lot through those 10 trades, but $50, that's not gonna blow up your account. That's the goal, right? And you want to take a lot of trades. You want to experiment with your strategies. Even if some of the setups are lower quality, that's fine. Experiment with it so you could learn through experience and just take a ton of trades and practice everything that you just learned in the education. Keep in mind that during the step 2 application phase, your focus shouldn't be to make money. I don't want you to care about the end result of every single trading day. I want you to detach yourself from the outcome and focus on the process. And specifically, you're going to be focusing on what is working in your trading and what isn't working in your trading. And the only way that you could figure that out is through step number 3, data collection and observation. And this is when you're going to be journaling your results. And no, I don't mean your profits, okay? I don't care how much you're making day to day. I want you to journal what strategies you resonate with, what types of stocks are you most profitable with. For example, for me, I really gravitate towards mid to low caps, and I don't really like trading stocks that are over like $50 to $100. I also don't really trade the name brands. So I won't day trade Tesla or Amazon or Apple. I just don't really gravitate towards those types of stocks. Now, other traders may gravitate towards them, right? I just know what I like because I figured that out very early in my trading career. Another example is with the strategies that I resonate with. I really like breakouts. I like breakouts more than I like retracement setups. Now, retracements are still within my trading methodology, but I always naturally gravitated towards trading breakouts, right? That's just what works for me. But that might be different for you. That might be different for every single trader. Same thing with the trade management. For me, I really enjoy scalping. I love kind of getting in and out of positions quick, right? I get big size, I go for a bit smaller moves, and I'll take profits quick, and I'll do that a lot of times every single day, and my profits really add up. And that's what I like to gravitate towards, right? Now, I do other styles of trading as well where I'll get in and I'll hold that trade for a few hours, but I wouldn't say that's my bread and butter. I still know how to do it. I still do it almost every single day, but that's not like my bread and butter strategy. So you need to figure out what you resonate with. What style of management do you like? Do you like kind of getting in and out quick, which is a lot more active? Or do you like perhaps getting into something in the morning and then waiting until, the end of the day to get out? And the only way that you're going to figure this out is to apply, is to practice and trade everything that you've learned in your education. And as you're practicing and trading, I want you to be journaling what you're gravitating towards and which strategies are making you money. And I want you to do what makes sense to you. Do what you resonate with. When you take a trade, you usually get a really good feeling about it. And there's always going to be a style of trading that you're like, yeah, I just like this. I could feel it, and you almost develop an intuition for that style. And that's what I want you to accomplish through this data collection and observation point. Now, in the beginning of your journey, you're not going to know exactly what you resonate with at first. You're not going to know which strategies are most profitable for you. That's going to take time. And that part is difficult to really identify. But what isn't difficult to identify is figuring out what's not working in your trading. It's pretty easy to figure out what's consistently not making you money. So I want you to really focus on that. Focus on what isn't working. Example, maybe every single day you start the day down 2 to 3 hours. Every day at the market open, you start the day down 2 to 3 hours. Perfect. Stop trading the market open. Eliminate that from your trading plan. Maybe, 50% of your trades are going for reversals and you're consistently losing money on reversals. Fantastic. Stop trading reversals or just be way more selective with reversal setups. You get the idea. Figure out what isn't working and then eliminate it. And then what you're going to be left with are strategies and the styles that are working for you. Let's move to step number 4. Focus on breaking even consistently and raising risk gradually. Your first priority as a beginner trader isn't to become profitable. It's to become a consistently break-even trader. A break-even trader is someone who doesn't lose, who knows risk management, who knows how to limit their losses. And by becoming a break-even trader first, when you know you're consistently not losing, that's going to give you a lot of confidence. And that confidence is what you need to become profitable. So in the beginning, when you're just starting out, you don't want to go from beginner to profitable. You want to go from beginner to consistently break even and then break even to profitable. Once you're a break-even trader and you're not losing every single day, you're like 80% of the way there towards becoming a profitable trader. And as long as you're focusing on step 1, step 2, step 3, and step 4, and you're putting in the work, you're consistent, you're disciplined, you're going to see some genuine progress. In fact, you might even begin making money with like $1 to $10 risk, where maybe you're making $10 a day, $20 a day, $30 the next day, 10 the next day, 40 the next day, right? And you're seeing that results are starting to come in. Now, a big mistake that traders make is that they go from like $1 to $10 risk to like $100 risk or $1,000 risk instantly. You don't want to do that. In fact, if you can't make money with $1 to $10 risk, you won't be able to become profitable with $1 to $1,000 risk. Keep that in mind. And you want to raise your risk gradually. And you don't want to just, quadruple your risk overnight. If you're risking like $1 to $5 per trade, go from like 1 to 5 then to 5 to 10. If you're risking $10 a trade, go to 15. If you're risking 15, then go to 25, right? Do it gradually. And I would only raise your risk when you have more than 2 weeks of consistency and when you're feeling strong psychologically. I get asked this question all the time, Emmanuel, when should I raise my risk? I feel like I'm ready, but I'm not sure yet. If you're in doubt, don't raise your risk. You want to be raising your risk when you're feeling good, you're feeling confident, you have consistency, you now have a track record of success with smaller risk, and that justifies you raising your risk. If you're kind of in doubt and you're not sure, don't raise your risk. You should be raising your risk when you're psychologically strong, okay? And in the beginning, your risk is actually going to increase rapidly and pretty quickly, where I've seen a lot of traders go from, let's say $10 risk to $100 or even $200 risk per trade rather quickly within a few months. But as you raise your risk more and more and more, that rate of increase is going to slow down, where you might go from $10 to $100 risk pretty quick, but then it's going to take more time going from 100 to 300 or 300 to 500, etc. So the higher your risk is, the slower it's going to take to actually raise it, because when you're dealing with big risk, that's going to come with a lot of emotional and psychological impact, where if now you're risking $1,000 per trade, that's going to feel completely differently than when you're risking $100 per trade. And you have to understand that the overall process of becoming a profitable trader is exponential. So let's say we have this little graph here, we have time below, okay, and then we have profits here. Most people think that this process is linear. These steps that I just showed you and the steps in this video, it works like this. You're putting in a lot of time, you're practicing, you're building your system, you're building your edge, but you're not really seeing any results. You're not seeing any results, and then all of a sudden your results just go exponential as soon as things click. And you don't want to quit trading before this happens. You want to put in and thug it out and go through all the struggle, put in the time, put in the work ethic, be disciplined throughout this entire stage right here where you're putting in a lot of time but you're not seeing results, because at some point your results are going to go exponential, and when this happens, it can completely change your life. So going into step 5 at this point, maybe you're feeling really good about your trading. You raised your risk from $10, now you're risking $100 per trade. Everything is clicking, you're feeling invincible, you're making $400 or $500 a day. Maybe you're even making $1,000 or $2,000 pretty consistently, and you're feeling great. Well, this is going to happen next. And that is, you're going to see something like this, where you see a dip in your trading. And that goes into step 5, which is your first major setback, okay? And when you think you have everything figured out, where you're making money, you're feeling good, you're feeling invincible, you become complacent. And unfortunately, you stop putting in as much effort towards the other steps of the process, like the data collection, like raising risk gradually, or focusing on the application and journaling. Maybe you're starting to ignore that because, hey, everything's figured out, you're making money. And what happens is you fail to adapt when the market changes. And I see this all the time where profitable traders, they lose their profitability. They become losing traders because they're not able to keep up with the market. You have to understand that the market is constantly changing from week to week, month to month, from year to year, and you need to always be sharpening the tools in your toolbox. You always need to be working on your trading. You always need to be journaling. You always need to be refining your process and working on your system. The moment you stop doing that, and that usually happens during this parabolic stage, because you put in all this work, you're seeing those results going parabolic, then you relax, you become complacent, you stop working on your trading, and then you see a major dip and you refuse to adapt. In fact, a lot of times, most traders just force the same strategies that made them money before, but those strategies, they're not as effective anymore. And you always have to be okay with lowering your risk, accepting, hey, I'm not seeing the same results like I did 5 months ago, right? You have to be okay with going back to the drawing board, refining your system, and changing things around. And this happens to everyone. It even happened to me, where I had a really nice parabolic move in my results. I was making money consistently, and then all of a sudden the market kind of changed, and I saw a big setback in my trading. And from there, and I wasn't losing money, right? Keep that in mind. The reason I'm profitable is because of how good I am at limiting my losses. During the setback, I really lowered my risk. And then it kind of went like this, and then I kept putting in more time, working on my system before the next parabolic move up. And that's kind of the journey as a trader. You put in this work, you see a big uptick in your results, you see a little setback, you put in another, a lot of time, a lot of work, and then you see another parabolic shift in your results. You have to be okay with adapting to the market. You have to be okay with change. In fact, the only thing that is constant is change. And I'm gonna be completely honest, during this first major setback in your trading, it is going to hurt your ego. You're going to think that you got lucky. You're gonna think that, oh, well, maybe I'm not so good of a trader after all. And it's going to be tough to adapt and go back to the drawing board. It's gonna be tough to accept that you have to lower your risk and kind of reset everything in your system. And a lot of traders quit here, or a lot of traders over risk, over trade, and then they end up giving back all of their profits during this exponential stage in their results, right? You want to avoid that. Make sure during this setback, you are protecting the profits that you made here. Make sure you lower your risk. Maybe you even have to go to paper trading for like a few days or a week just to kind of reset. On the other hand, when you overcome this setback and you see your results starting to go up again, where you've adapted your trading, you've re-raised your risk, and you're starting to become profitable again, well, that's going to give you so much confidence, and it's going to completely almost shift the way that you look at trading. You're going to be like, yeah, I am a profitable trader. I stayed resilient and I overcame that setback. And then any new setback that you see from here is going to be way shorter than this one, because you have confidence in yourself that you can adapt to the new environment, and you can overcome any obstacle within your trading. Let's go to step number 6, and I have a lot of personal experience with this one. Mentorship is going to expedite every single step of this process, and I'm going to be honest and blunt. If you don't have a mentor, it's likely to take years to figure this out. And the way that I know that is because my father went through that path. It took him 7 years to become a consistently profitable trader because he had to learn through trial and error. He had to experiment with stuff, and he never really learned correctly from the very beginning. But when he taught me, it only took me 3.5 months to begin making money with trading. And I don't care who your mentor is. I don't care if you pick your friend or someone else on YouTube. That doesn't matter to me. All that I want to emphasize here is make sure that your mentor live trades with you, where he or she shares the screen and you're able to ask questions in real time and you could actually watch their execution. That is the best way to learn how to trade. It's by doing it with your mentor. So like I said, I don't care who your mentor is, but if you do want to learn from me, I have hundreds of hours of free education online on my YouTube channel, but also in my free 10+ hour trading course that I mentioned earlier in this video. But if you do want to work with me personally, you want me to take you under my wing, I do personally help coach and scale traders from zero to consistently profitable, where my students trade live with me every single day. So if you are looking for a personal mentor, you could apply for my mentorship in the description of this video. This was by far the most important piece of advice that my father told me when I was a beginner trader. And for anyone that doesn't know, my father was the one who taught me how to trade at the time. And this was 4 years ago. He had been trading for about 4 to 5 years full time. And now 4 years later, it's close to a decade. And I remember us sitting in our sunroom and he was teaching me, he was showing me different strategies, teaching me his methodology. And I remember he told me this really important piece of advice that completely changed my perspective as a beginner trader and it helped me reach success significantly faster. And I want to share that with you guys. I want to genuinely help you guys learn how to trade. And sometimes, you know, with trading, especially since it's so much about your psychology, your emotions and your mindset, that sometimes your skills are not even what has to be changed in order to become profitable. Your mindset is what has to be changed. So I hope, especially if you guys are beginner traders, this completely changes your mindset. All right, so a lot of people want to go from beginner trader and they want to immediately become a profitable trader. Their number one goal is to make money, which makes sense. I mean, we all are doing this to make money. We want to become profitable. We want to make money. We want to buy, whatever, the cars, the watches. You want to take care of your family, go on vacations, have a full-time, do this full-time, whatever the case is. This is generally what people want to do, go from beginner to profitable. But my dad told me that this is not the way that you should be going about trading. Instead, you're actually skipping a very important part in the middle. And because you're not focusing on this part that's in between being a beginner and being profitable, you're actually, kind of going against yourself. It's actually counterproductive. All right, so I want to explain what this is. So let's go ahead and erase this. And my dad told me that your first focus as a trader should not be to make money. It should be to consistently not lose money. And that, in other words, is called breaking even. And my dad told me that if you're able to break even consistently, every single day you're able to not lose money, you're like 70% of the way there towards being a profitable trader. So honestly, we should actually move this. Let's see if we can actually, let's move this. 70%, it's more like down here, right? If you're able to consistently not lose money and consistently break even, you are like 70% of the way there to being a profitable trader, all right? Because not losing money consistently is huge, right? And that means you already have a pretty good risk management system, right? We'll do RM, risk management system. It means you're able to limit losses, which is huge, right? And you probably also have a pretty good trading management system, trading management, right? So this should be your mindset. Instead of going into the markets every day thinking about, oh, am I gonna make money today? Am I gonna be profitable? Is this the first day I'm gonna make my first $1,000? Instead, focus on, okay, my goal today is to not lose money. By the end of the day, I either should be at $0 on the day or maybe up $5, $10, a small amount, right? And you should think about break even days as winning days, especially if you're just starting out, right? So if you're breaking even consistently, right, I want you in your mind to consider that a win, consider that a victory, right? And then if you have one whole week where you didn't lose any money, where you broke even the entire week, that's a winning week. That's a good week. Because a lot of traders, especially as beginners, you're not going to be able to make money right away. It's just not that easy. It's not that simple. As a beginner trader, 3 weeks later, you're making money. It doesn't happen, right? But a lot of traders, when they're just starting out, because they're not immediately profitable, they're like discouraged. They like almost don't want to trade anymore because they're not making money, right? And when they do break even, let's say, they don't really think of it as anything good. They're just like, oh, whatever, I didn't make money. Today was a horrible day. And that alters their mindset, right? And instead, I want you guys to treat break-even days in the beginning as profitable winning days. And if you're able to consistently break even, right? There are probably just a few small fixes that you have to make in your trading to become consistently profitable. All right. And honestly, this is the way that I thought about it. And even if you're paper trading, right, which is trading with fake money, you're not trading real money, it's like practice trading, I still want you to focus on breaking even every single day. Okay, you can experiment, you could try different strategies. Of course, if you're experimenting and if that experiment doesn't work out, yeah, you're probably going to lose money. But over time, if you're continuing to paper trade, I still want you to focus on breaking even consistently. All right, and that's what I did. I paper traded for 3 to 4 months. I think in hindsight, that was a bit too long, but I can't really go back in time and change that. But even when I was paper trading, I considered every single break-even day a winning day. I considered that a victory. I considered that progress, and it gave me momentum. Me thinking about breaking even in that way, right, actually, gave me more motivation. It gave me more momentum to continue studying, continue improving. You know what I mean? And I think that can be really helpful for essentially any trader. All right. And I remember at some point I'm like, wow, I've been breaking even for a few weeks now. And then boom, I had my first winning day. I had my first consecutive winning days. And then all of a sudden I had my first week where I made money every single day, or with paper trading, of course. And that gave me even more momentum. And then when I started trading with real money, on my first day, guys, I made $711, which is insane. It completely changed my world. But it was because, for 3-4 months, I was paper trading. I had the right mindset, and I was focusing on consistently improving. Okay. And of course, I had my dad, right? That's really, the game changer. You really ideally need a mentor if you want to be able to succeed super quickly. All right, guys. So yeah, hopefully this helps you guys focus on breaking even if you're a beginner trader. That will give you momentum to eventually become profitable. If you guys haven't started watching my free 8+ hour course, it's listed on my YouTube. It's also in the description of this video. You can hop into my free community. You can watch the course, interact with other students, interact with myself. I do free classes every single Thursday that are live. And I teach you kind of the framework on how to make your first $10,000 with trading. Make sure you go to those classes every single Thursday. Very, very important. And yeah, if you're looking to take this a little bit more seriously, maybe you went through all my free courses and all that, and you want to trade live with me every day, you want me to take you under my wing and mentor you, shoot me a DM on Instagram. I'm going to list that below, Emmanuel Trades, and I can give you more information about my mentorship program. All right. Hopefully this video helps. Hopefully this video kind of changed your perspective and hopefully gave you a lot of motivation, especially if you are someone who is a break-even trader. This should hopefully have definitely helped you. So see you guys on the next video. Welcome to the price action chapter of this free course. And in this chapter, I'm going to teach you everything you need to know about reading and interpreting price action. And keep in mind, as traders, we only look at price action when it comes to making our decisions. We're not looking at financial documents. We're not reading the news. We're not reading income statements. We are solely focusing on reading price action. And I'm going to teach you how to read candlesticks. I'm going to teach you what indicators I use. I'm going to teach you how to read volume, how to read support and resistance, relative strength in the markets, and everything you need to know to be a price action professional. So make sure you pay attention and let's hop right into this chapter. What is going on, guys? Hope you guys are having a great day. And I'm very excited that you're watching this video and that you have committed yourself towards learning this course. And today we are going to be talking about a very, very crucial element of price action. And remember, price action is the only thing we use to perform technical analysis and analysis for trading when it comes to trading stocks or crypto. Okay, these are the very fundamentals that you have to innately understand if you want to succeed with trading. This is the meat and potatoes of trading. It's the absolute basics. So my recommendation is get out a notebook, grab a pen or a pencil, and make sure you take some notes so you really can digest this information. You need to understand this to move forward with the course, okay? So I have the presentation ready to go. So grab the pencil, grab the notebook, and I'm gonna turn off this camera real quick. Very good. And let's get started. So we are going to be talking about candlesticks, okay? And why do we use candlesticks? And candlesticks are the bars that you guys see on all of the price charts that we're viewing in the community or that you may have seen in the past. And those bars are, they're candlesticks. And I'm going to give you guys a little bit of a history of the candlesticks, why we're using them and what they mean. So number one, we're using Japanese candlesticks, and they focus on the open and the close of a bar, okay? And we have to remember that, when we're looking at a candlestick, that represents a time frame. So we're looking at the open of that time frame and then the close of that time frame. It's going to make a little bit more sense in a second here. So Japanese candlesticks, what they present is they show a graphic representation of the supply and demand for each time period's price action. And we have to remember that's how a market operates. It operates off supply and demand. Supply meaning the sellers and demand meaning the buyers. Okay, that's how a market functions. There has to be buyers and there has to be sellers. And obviously if there's more buyers than sellers, then the price is going to go up. And if there's more sellers than buyers, the price is going to go down. This is how a market functions, okay? And candlesticks, they give us a representation of that, supply and demand of those buyers versus the sellers, okay? And maybe a lot of you guys have seen bar charts and versus candlesticks, or maybe you guys have seen like Heikin-Ashi candlesticks. I always 100% recommend Japanese candlesticks, which are just the regular candlesticks on TradingView or whatever platform that you guys are using. They're way more visual. They give you a very clear picture on the price action that's occurring. And like I said, they emphasize the relationship between supply and demand. Okay, if we understand the supply and demand of what we're looking at, of the stock or crypto that we're looking at, then we could take advantage, of that supply and demand and make a profit. That's the whole point. And that battle between the buyers and the sellers, right? This supply and demand element that I'm talking about, it's the most important part of technical analysis. This is what makes technical analysis.
That's why it's so crucial for you guys to really pay attention and understand how to read these candlesticks. So how are they formed, right? And depending on which time frame you're looking at, a candlestick represents the price action that occurred during that time. So if we're looking at a 5-minute chart, right, each candlestick on that chart represents 5 minutes worth of time, right? So for example, you know, we talked about kind of the open and close of the candlestick. Let's say it's 10 a.m., right? And a 5-minute candle started forming. At 10 a.m., the candle, obviously, the 5-minute candle started forming. And then at 10:05, the candle stopped forming. And then the next candle started forming at 10:05. And then at 10:10, that one closed. And then another one starts forming. So you can see that every candlestick represents, you know, a unit of time. And obviously on 15-minute charts, every candlestick represents 15 minutes worth of time. And on daily charts, every candlestick represents 1 day's worth of time. You guys get the idea. And if you're asking yourself, why are we looking at different time frames? I'm going to be talking about that later in the course, but it's very important that we're looking at several time frames and reading the candlesticks that are on several different time frames. And we're going to get into that a little bit later in the course. So let's start with the absolute basics on how to read candlesticks. Like I said before, candlesticks emphasize the open and the close of a bar, right? So if it's a green candlestick, that means price went up in that time frame, right? In that candlestick's time frame. So if it's a 5-minute chart, that means price went up in that 5 minutes. If it's a 15-minute chart, price went up during those 15 minutes, okay? So the bottom of the candle, or the body of the candle, this is known as the body. The bottom of it is where price opened. The top of it is where price closed, right? And these little lines here, you can call them wicks or tails. They represent the absolute lows during that time, right here. And the upper wick represents the absolute highs of price during that candle's time. Okay, so if it's green, and obviously it closed higher than it opened. So that's why this is where it's closing, this is where it's opening. And the wicks, like I said, highs and lows. If it's a red candle, that means it opened at a higher price than it closed, right? That means it went down during that time frame. So it closed at a lower price than which it opened. These wicks, they represent the same thing, the absolute highs of that candlestick and the absolute lows of the candlestick right here. Okay, so if it's red, it went up. Oh, I'm sorry. If it's red, it went down. If it's green, it went up. Okay, and the one question we always have to be asking ourselves here is, who won the battle, the buyers or the sellers? Okay, so let's look at this diagram to have a better understanding of what different candlesticks mean and how different candlesticks can form. So first and foremost, we have this is called a wide range bar, and this is one example where the candle opened at this price and closed at the absolute highs up here. If you guys see, there's no tails, right? There's no wicks, meaning it opened at the absolute lows and it closed at the absolute highs. That's why we don't have any tails. This is a very bullish candle. Remember, bullish means indicative of strength, meaning there's a lot of buyers. So this is a buyer heavy or buyer dominant candlestick. If you look at this one, we have here what's called a topping tail. Okay, and we're going to talk about how topping tails are formed during the next slides. But let's try to understand how a topping tail is formed here. So we open at the absolute lows, we rally all the way up here to form a high, and then the sellers come in and they bring it all the way back down to close here, right? So we opened here, we went all the way up, then we dropped and closed here. So opened here, closed here. So, this is a green bar, right? And a lot of you guys might be thinking, oh, it's green, that must mean it's bullish. It must means it's a buyer heavy candle, right? Buyer dominant candle. But in reality, what happened here is we opened here, we got bought, and then the sellers came in, right? And they brought the stock or crypto all the way back down to close here. So although it's green, right? It's a very seller heavy candle, right? So this is a topping tail. So if we go here, topping tail, it's a clue that the sellers have taken control, right? Because the buyers brought it up to here, and then the sellers are bringing it all the way back down. The sellers have taken control. If we look at this candlestick, excuse me, you could see that the tail is actually on the bottom. So this is a, excuse me guys, so this is a bottoming tail. And bottoming tails are a clue that the buyers have taken control, right? Because we opened at this price, the sellers sold it and brought it all the way down to here just for the buyers to come back here and bring it all the way back up, right? So the sellers tried to bring it down, but then the buyers brought it right back up to finish at the highs, okay? And then right here we have a doji bar, right, where it's kind of the battle between the buyers and sellers are even, right? Because it opened here, it went all the way up, then it went all the way down, and then it finished here. So a doji bar shows kind of a battle between the buyers and the sellers, and a battle that nobody really won. They kind of finished even, okay? Same thing with this bar. Obviously the buyers won a little bit, but it's kind of like a, you know, the sellers and buyers were very even. So what I want you guys to ask yourself is, looking at this candlestick, right? We know that it opened here and closed here. In this case, it opened here, dropped, and then closed here. So I want you guys to ask yourself, and maybe even pause the video, which candlestick out of this one and out of this one is more bullish? Which one is more indicative of strength? So pause the video, think about it, and come up with an answer, and I'll go over it just in a second here. I'll give you guys a chance to pause it. Okay, very good. If you guys chose this one, then you would be correct. This one is a stronger candle than this one. And the reason is for this one, right? It opened here, the sellers came in, and then the buyers, you know, then were like, hold on, you know, you can't bring this any lower, and they brought it all the way back up. You can think of this bar as battle tested, right? The sellers actually showed up, but the buying pressure was so strong that it negated all the sellers, and it brought the stock all the way back up to make new highs. In this case, we opened here and we sold here, right? We opened here and we closed here. We don't know if there were that many sellers during this bar. Maybe the sellers were sleeping. They weren't there, right? But this bar is actually battle tested, right? We had sellers shown up, but they were irrelevant. Here we just kind of closed at the highs after opening at the lows. So this one is way more bullish. Something to, you know, the buyers have really taken control. It's very buyer heavy. Looking at the red candlesticks, guys, it's the absolute same idea. We open here and then we close all the way at the bottom. There's no tails, meaning we open at the absolute, you know, we opened at the absolute highs, we closed at the absolute lows, okay? If we have a topping tail here, what happened was we opened at this price, the buyers showed up, they brought it all the way up here, and then the sellers came in and brought it all the way back down. So a topping tail, guys, is a clue the sellers have taken control. So the sellers have really taken control. There's a lot of selling pressure during this topping tail. Here, it's kind of the same thing. It's a doji bar. The buyers and sellers are mostly even, right? There was a battle, but nobody really won the battle, right? In this case, what we have here is we opened at this price. We dropped all the way back down, and the buyers came up. You know, they bought it down here. They brought it all the way back up, and we still closed under the open, right? So that's why it's still a red bar, but since the bottoming tail, guys, it's a clue that the buyers have been taking control. So even though this is a red bar, it's still a kind of a bullish bar. And although this is a green bar, it's still a kind of a bearish bar, because we know that a topping tail is where sellers take control, a bottoming tail is where buyers take control. Hopefully that makes sense, guys. And let's kind of go into how they're actually formed, right? So if we have a 5-minute candle, and this diagram really shows that the importance of looking at different time frames, because candles can form in different ways, right? This 5-minute candle is the same as this 5-minute candle, but they formed completely differently, right? Here, it's right. We have 5 1-minute candles make up a 5-minute bar, and here 5 1-minute candles make up this 5-minute bar. But in this scenario, we have 5 candles that are going straight up, right? One after another, right? While here we have a big rally and then kind of, consolidation up here, meaning the candles, they're just staying at the highs of this candlestick, right? They're just staying here at the highs. So this kind of proves the point that candlesticks form in different ways. And that's why it's important to look at different time frames, because these two setups are different, right? This has different implications than this does. Okay, and we're going to be talking about that later in the course, but I just want to stress the importance now of looking at different time frames, because if the candlesticks have formed in different ways, that's going to give you information of what it might do next. Okay, so that's really what I want to emphasize. They could form in different ways, and that's important. So if we look at, for example, a 15-minute candle, this is another example of how they're formed, right? Here we have 3 5-minute candles. Here we have 3 5-minute candles. You can see this one's a little different. It's kind of a, we have a rally and then we just continue higher. Where here it's, again, rally and then we just stay at the highs. We don't really, continue higher. So they're formed in different ways, okay? And you'll see later on, once we actually start talking about different strategies, you'll start to really understand the importance of how the candlesticks are forming and the patterns that they're setting up in, and how they look on the charts on different time frames, okay? But I don't want to overwhelm you with all that information now. For now, just understand that different candlesticks form in different ways when you look at, the smaller time frames or the larger time frames, okay? So that's what's important. So let's understand how bottoming tails are formed. So like I said, we open at this price, right? This is where we're opening, and we drop. So this is a larger time frame, and by looking at the smaller time frames, we see more candlesticks. We see exactly how this candlestick was formed and what went into it. So we open at this price. Excuse me, guys. I'm just going to grab a sip of water. Sorry, guys. So we open at this price. We drop all the way down to make absolute lows, and then the buyers show up and they bring it all the way back up to make new highs. So this is a bottoming tail, guys. Remember, a bottoming tail, it's a clue the buyers have taken control. And this, it kind of makes sense, right? The sellers came in, but then the buyers dominated. They brought it all the way back up to make new highs. So this is kind of how, this gives you insight on how a bottoming tail is formed. And at the end of the day, we see that the buyers have taken control. Even if it's a red bottoming tail, right? We have a green one here. Even if it's red, you could still see that the buyers have taken control, even though, it's still closed at a lower price than it opened. So we opened here, we dropped all the way back down to make absolute lows, and then the buyers take control and they bring it almost back up to the highs, but not quite. So you could still see that the buyers have ended the move. The buyers have taken control. If we look at a topping tail, we open at this price, we rally, the buyers come in, it rallies, we make absolute highs, and then the sellers come in, they dominate, and they bring it all the way back down to make new lows, and we close at a lower price than where we opened. That's why it's red. And we could see that the sellers have taken control. So remember, a topping tail, very important. Topping tail is when the sellers have taken control. Okay? Another example, even when it's green, we open at this price. Buyers come in, they rally, we make absolute highs just for the sellers to show up, and they end the move. And although it's green, we could still see that the sellers have taken control. Okay? With a doji bar, we talked about how a doji bar represents a battle that neither the buyers or the sellers won. And in certain circumstances, the doji bar is a very effective reversal and entry bar. So that's really important. A doji bar is an excellent entry bar. And we're going to be talking about that a little later once we actually start going through the strategies. Okay, so that's the end of this beginner candlestick class. And if you guys are a little bit confused on what these candlesticks actually mean, how to read them in sequences, or actually applying this information, just stay tuned. It's all going to make sense as the course progresses. But please just make sure that you understand what a doji bar means, how what topping tails mean, what bottoming tails mean, right? And just understanding that candlesticks form in different ways. And looking at how a candlestick forms gives us a lot more insight on what's going on with that stock or with that crypto. But we're going to be talking and going more into detail as the course progresses. Just make sure you understand everything we talked about today. Okay, guys, let me put my camera up one more time. So I would suggest also rewatching this video if you don't understand it completely, guys. Let me know if you have any questions, and looking forward to seeing you guys in the next section of the course. Thank you, guys. What is going on, guys? Hope you're having a great day. During the last class, we talked about the basics of candlesticks, and we learned some of the fundamentals of what candlesticks are, why we're looking at them, and what they really signify. And just for a reminder, they signify and they show the relationship between supply and demand, between the buyers and the sellers. And if we can understand the relationship between the buyers and the sellers in the candlesticks, and we could see the patterns and the way that they form and understand what that means, we could take advantage of it and find, hopefully super lucrative trades. So during this class, we're going to be going into the advanced candlestick course. So I'm going to share with you guys some additional details and some other types of candlesticks that are important to recognize. Okay. My recommendation is, if you haven't watched the previous course, if you're still kind of confused on topping tails, bottoming tails, what candlesticks are, how they show different time frames, then definitely take a step back, maybe reach out to me, ask me some questions before you go into the advanced course. Okay, so I'm going to turn off my camera. Perfect. And let us begin here. So this is the advanced candlesticks course. Let's get right into it. So for mastering candlesticks, we have to really understand that some candlesticks are more important than others, and they give us different types of information that we could use to base off of when we go into trades. And there are very specific candlesticks that we are looking for when we time our entries into stocks or crypto, right? And later in the course, when we actually talk about different strategies and different ways the candlesticks, the different patterns that they can form, it's going to make a lot more sense, and you're going to really see why we look for specific candlesticks in certain situations. And there are also specific candlesticks that we look for when finding reversals. And there are also specific candlesticks that can enhance trading strategies and increase the odds of success for a trade. So something that we need to emphasize is the way the candlesticks form. Number one, they give you different information about what's happening in the trade, and they also make trades a lot more potent. Where if you find a specific pattern or a specific strategy, having some specific type of candlestick that we're looking for can greatly increase the odds of that strategy working and you actually making money. So that's why it's important to pay attention here and master the candlesticks that we're about to learn about. So as a reminder, topping and bottoming tail is really important that you guys know this. Topping tails, right here, tail at the top, suggests that the sellers have taken control, right? The sellers have taken control for both, the green and the red bar. For bottoming tails, it's the opposite. It suggests that the buyers have taken control. Really important that as soon as you guys see these sort of candlesticks, you know exactly what they mean. And these bars are going to provide you lots of insight on the price action that's occurring with stocks or crypto, okay? And it's really useful when we pair these sort of candlesticks with the strategies that we're going to be learning. It's all about pairing things together to create a more potent trading setup, okay? So now let's go into narrow range bars. And a narrow range bar, they are bars that have a small distance between the high and the low of that candlestick, meaning there really isn't all that much price action that's happening, right? There's not, we're going to see an example in a second here. It's going to make a little bit more sense. They're pretty significant when they occur after a multi-bar move because, you know, they might serve actually as a reversal candlestick. It gives you kind of more evidence that a reversal might take place, right? And they're also especially useful for buy setups, 1, 2, 3 patterns, and reversal setups. And we're going to cover that when we actually start with the strategy section of the course. So let's look at what they are. Here we have normal ranged bars, right? You see a big bar like this open at this price, right? Drop to these lows, went all the way up to these highs, and closed here. Same thing with this. These are kind of normal range bars. These are what narrow range bars look like. Whoops. You could see that there's not that much distance between the open and the close, right? The open and the close. They're kind of smaller candlesticks, right? So these are what they look like. So if you see a bar candle like this, just know it's a narrow range bar, okay? Make sure you're able to identify that. Wide range igniting bars, okay? This is also really important to be able to recognize. A bullish wide range igniting bar is an above average size bar that has its open price near the lows of that time period and its close price near the highs of that time period. And it suggests that it's very bullish and that many traders are playing long. And we actually saw what this looks like during the beginner course. However, I'm going to show you guys another example in a second. A bearish wide range igniting bar is an above average size bar that has its open price near the highs of that time period and its close price near the lows of that time period. Suggests many traders are playing short. So this is a great example of what they look like. Just give me 1 second. I'm gonna have a sip of water in 1 sec. So why are they bullish or bearish wide range igniting bars? Because here the open is near the lows, right? And the close is near the overall highs, right? We don't have a large bottoming tail. We don't have a large topping tail. Same thing here. We opened near the highs. We closed near the lows. And these bars show you that there is a new move that's being ignited, especially when it's coming from a consolidation. And I'm gonna show you guys examples of that later, okay? But the whole point, you just make sure you recognize that these are igniting bars, okay? They're bullish or bearish wide range igniting bars. Make sure you're able to spot one, okay? And that's really all we're going to talk about. So for this class, if you're still a little confused on how we're going to use these candlesticks, don't worry, we're going to address that. The whole point of these 2 candlestick lessons is to, make sure that you guys familiarize yourself with identifying, for example, wide range igniting bars, narrow range bars, bottoming tails, topping tails. You should know when you see a candlestick that's, for example, a topping tail, you should be able to immediately say, hey, that's a topping tail. I know what I'm looking at. Or if you see a narrow range bar, it's important to look at that and be like, okay, that's identify it for what it is, right? So once you understand all of these candlesticks, how candlesticks show you different time frames, right? What's the point of them? You're going to be able to move on to the next section. Okay, guys. So hopefully this makes sense. Please reach out to me if you have any questions. And if you're, if you understand everything we've done so far with the candlesticks, you're finding it easy, then that's great, because you already just learned a crucial part of price action, a crucial part of reading technical analysis, and you're well on your way to finding trades, understanding what the candlesticks are doing to certain patterns, and it's going to make a lot more sense once we go over the strategy section. But proud of you guys for sticking with it so far, and I'll see you in the next class. Thank you. What's going on, guys? Hope you're having a great day. For today's class, we are going to be talking about the 3 different trends that exist in trading and with price action. Okay, so these are super basic trends that you guys should know how to identify, and you should know the implications of these trends as well. So let's get right into it. The 3 different trends. This is probably stuff that you've heard of already. So when we're looking at an uptrend, it's characterized by 2 different characteristics. Number 1, higher highs and higher lows. And number 2, a rising 20-day moving average. So we haven't covered how to use the 20-day moving average, but just always keep in mind that we want a rising and a trending higher 20-day moving average. Okay, so as you can see, we have higher highs, right? We're making new highs and we're making higher lows, right? This low is higher than that low. This low is higher than that low. Same with the highs, okay? And as you can see, this line, the black line, which is the 20-day moving average, it's under price, and it's also trending higher. And we're going to be doing the 20-day moving average class next, so just stay tuned for that. Okay, so this is what an uptrend is. Very simple stuff. We're looking at a downtrend. It's characterized by, number 1, lower highs and lower lows. Okay, we have lower highs, right, and lower lows. So low here, low here, low here. And as you can see, we have a declining 20-day moving average, which is this line. So as you can see, during a downtrend, we want the 20-day moving average to be overpriced, right? And we see that during the downtrend, it sort of retraces, right? It always rallies right to the 20-day moving average, drops, rallies right to 20-day moving average, drops. But we're going to be looking at the 20 MA during the next class. So this is what a downtrend looks like: lower lows, lower highs. Okay. And we also have a sideways trend, which is characterized by relatively equal highs and lows, right? We rally, we make a high, we drop, right, to the previous low, we rally to the previous highs, drop to the previous low. Okay. And once we talk about support and resistance, this is going to make a lot more sense. But this is what a sideways trend is. So sideways trend, it's not, we don't have one particular bias. We don't have a bullish bias or a bearish bias, right? Overall, we're just sort of fluctuating between the highs and the lows. Okay, so this is what a sideways trend is. And usually sideways trends, they lack momentum, right? So with uptrends and downtrends, we clearly know what the momentum is, right? For an uptrend, there's clearly bullish momentum, right? We're rising. There's a lot of buyers, right? Over with the downtrend, there's a lot of bearish momentum. There are a lot more sellers. The sellers are dominating the move. But with a sideways trend, it's really, there's no clear momentum. We don't know exactly, are the buyers winning or are the sellers winning, just because we're kind of fluctuating between the highs and the lows. Okay, here's an example of a uptrend. This is a real chart with candlesticks, as you can see, right? We can see that we made a high here, we made a low here. This low was higher than this low. This high was higher than that high. Right here, also make a higher high, higher low. And as we continue going up, you can see that we're continuously making higher highs and higher lows. This blue line is the 20-day moving average. Okay, and as you can see, there's probably a ton of candlesticks that you're already able to identify, whether it's a topping tail, bottoming tail, narrow range bar, wide range igniting bar, which is really good, or doji bar as well. So if you're already looking at these candlesticks and you're able to identify the different ones that we've learned about, that's fantastic. Looking at a downtrend, or actually this is a perfect example of an uptrend, and that's followed by a downtrend, right? We could see here, this white line is the 20-day moving average. We could see we're making higher highs, higher lows until we actually reverse, and now we make lower highs and lower lows, right? So we're uptrending, then we go into a downtrend. And this is actually a screenshot of the NASDAQ ETF, the QQQ. So this is a very recent snapshot. So you can see that we went from an uptrend to a downtrend, right? Uptrend is higher highs, higher lows. Downtrend is lower lows, lower highs. Okay. Hopefully that makes sense. So just make sure you're able to identify whether an uptrend or a downtrend or a sideways trend is occurring. Okay, guys. And during the next class, we're going to be talking about the 20-day moving average, which is this white line. And I'm really excited to talk about that. It's extremely important. And hopefully this all makes sense, guys. And so now you guys should be pretty familiar with identifying several different types of candlesticks, and also identifying different types of trends that are occurring as well. All right, guys, have a good day. See you in the next class. Bye.
So I made $11,163 yesterday using all of the concepts that I'm going to teach you in this video. So I highly recommend watching until the end of the video, because this can truly be transformative for your trading. This is my Think or Swim screenshot on my phone. So it shows you all of my winning positions. It also shows you all of my losing positions. And this is my Think or Swim screenshot on my desktop. As you can see, May 9th, 3:53 p.m., $11,163. And I've had a lot of people that have commented under my videos, hey, why don't you show your profits and your results on your actual brokerage account, on your Schwab? So I listened, and here they are. Yesterday, May 9th, I made $10,831. The reason for the small discrepancy, it's around a $300 difference, is because Schwab takes off exchange fees at the end of the trading day. So this is my profits after fees. So this is for yesterday, May 9th. May 8th, 2025, I made $4,098. May 7th, Wednesday, I made $5,044. May 6th, that was on Tuesday of this week, I made $4,800. And May 5th, Monday, I made $2,879. So if you do the math, it adds up to around $27,500 in profit for me this past week. And the reason I'm showing you this isn't to boast, it's not to brag, but it's to show you that I actually do this for a living. Everything that I'm going to be teaching you in this video, I personally do to make money in the markets. And there are way too many trading educators that try to teach you how to trade, but they don't actually trade themselves. I want to be as transparent and as real as possible. So now that you know that this actually makes me money almost every single day, let's go ahead and hop right into the video. To preface this video, what I'm about to show you isn't revolutionary. It's not brand new. It's literally existed forever, but it is unbelievably powerful if you know how to apply it correctly. And the best part is, it is extremely simple to use. And in this video, I'm going to show you how I practically use this tool. I'm going to show you trades that I took this week and how I was able to use this tool to my advantage and make $27,000 this past week. And this mystery tool is the 20-period simple moving average. And I guarantee there are people that are watching this video that are thinking to themselves, simple moving average, what? Like, I thought he would be using MACD or RSI or Bollinger Bands or VWAP or stochastics or Elliott Wave Theory, all these complicated indicators. And no, I do not. The only tools that I use are the 20 SMA, the 200 SMA, 200 period simple moving average, and volume. But mainly, it's the 20 period simple moving average. I like to keep my trading simple. Trading is already hard enough given the fact that it's so psychologically and emotionally demanding. Like, you have to be really disciplined to be a good trader. That's already hard enough. Why would I want to overcomplicate my trading using crazy complex indicators, super cluttered charts, looking at 4 or 5 different things to analyze a stock? No, I don't want to do that. I like to keep it as simple as possible. And that's why I use the 20 MA, right? It's because of the simplicity. But it is so powerful if you know how to use it, which I'm going to show you in this video. And what is the simple moving average, the 20 MA? It essentially tracks roughly the last 1 month of trading data, and it represents that price action in a line. That is all it is. It is a line that helps us trade. There are other moving averages like the 10 MA, the 50 MA, the 100 MA, the 200 MA. And I really like the 20 because it's not too reactive like the 10 MA. Like if you get violent swings in price, the 10 MA is going to react super crazy. But it's also not too slow like the 50 MA or the 100 MA. It's like that perfect sweet spot where it represents the last 1 month of trading data. Now, I also use the 200 period simple moving average, mostly for support and resistance, and that is kind of like my long-term moving average. So I like to use the 20 SMA for my medium term and 200 MA for my long-term moving average. And the reason I use the 20 MA is because it is the ultimate trend following tool in existence. And a lot of people ask me, why does it work? Like a lot of my students, when they learn how to use it, they apply it in their trading, they would ask me, why does this actually work? Like, what's the reasoning behind it? And I've wondered this as well. And I honestly think it's because it's like a self-fulfilling magnet. There are so many traders, institutions, algorithms that use it that price just respects it in an unbelievable way that you're about to see. And, you know, at the end of the day, I'm not sure exactly why it works, but it works. And that's the only thing that I really need to worry about. So let's hop into how to actually use it. Number one, the main point here is the 20 MA is not effective when prices are sideways. It is only effective when prices are in a strong uptrend or downtrend, or there's strong momentum in one direction. We don't ever want to see a flat 20 MA. A flat 20 MA isn't really useful. It's not effective for our trading. What we want to see is a rising 20 MA if it's an uptrend, and we want to see a declining 20 MA if it's a downtrend. All right. So like I said, this is the ultimate trend following tool in existence. And trends, whether that's an uptrend or a downtrend, respect the 20 MA in this fashion, where you have the 20 SMA, it's under price, trending higher. All right. And if you've ever been to one of my free classes, you've heard kind of like the jingle, the song that I use, under price, trending higher, under price, trending higher, under price, trending higher. I literally want you to sing it to yourself so you can like cement it in your head. We want the moving average to be under price, trending higher during an uptrend. And the opposite applies during a downtrend. We want it to be over price, trending lower, over price, trending lower if it's in a downtrend. In this way, right? Rising 20 MA, and we have an uptrend. And what you're going to see is that within that trend, prices respect the 20 MA. They trade off of it, where you could have a pullback into that rising 20 MA, right? You could also have a consolidation into that 20 MA. And the same thing applies if it's a downtrend. All right, so we get a move lower, and then we retrace into the declining 20 MA, move lower, retrace into the declining 20 MA. That's what you really need to understand. Let's go ahead and look at some examples. So step number one, we have an established downtrend, and that's extremely important. We have lower highs, lower lows. Now, number two, what is the moving average doing? The 20 SMA is overpriced and declining. You could see how it is declining lower and overpriced. That's exactly what we want to see. So we have this initial consolidation directly into the declining 20 MA right here, and then we get the breakdown. Exactly what we want to see. Look at this. We consolidate directly into the 20 MA. Literally, as soon as it touched the moving average, that's when we broke down. And if you've watched my free 10+ hour course, which I highly recommend that you do, it'll completely build the foundation behind your trading. It's 100% free. It is genuinely better than most paid courses on the internet. It's in the description of this video, so you can begin watching it literally as soon as you finish this video right here. I actually also teach about the 20 MA in the free course, but you could use all of that education and combine it with this YouTube video as well. But if you've watched it, you know that I only really trade two types of strategies, and they are correction strategies. And I'll get to what that means in just a second. But the only strategies I trade are really, you get a move higher, you get a dip, then it sets up as a buy setup, and then I'll trade the continuation higher in that uptrend. Or it moves up, it consolidates, and then I will trade the breakout. This is essentially the foundation of my strategies. I keep it very simple. These are really the only strategies I trade, as you'll see later in this video when I break down my real trades, but that's what we got here. Consolidation, breakdown, consolidation, breakdown. And I used the 20 period moving average as my way of knowing when to position myself into the trade. All right, let's look at another example here. And honestly, just I don't even need to explain it. It's so simple to look at. Just look at how many times price respects the 20 MA within this uptrend. Like as soon as it started curling here, this was kind of like the start of the uptrend. Right here, it kind of almost touched it. Right here, right here, right here. It literally touched, the tail touched it. The tail touched it right here and then immediately started moving higher, right? Let me move this here. Okay. Same thing. So here, again, hit the 20 MA, started rallying, hit the 20 MA. The tail touched the 20 MA. It kind of broke through the 20 period moving average here, immediately got rejected to the downside and then continued higher. Especially right here. You could see like it's obvious, it's simple. And that's the reason why I use it. Even like any beginner could look at this and be like, yeah, wow, price really respects the 20 period moving average during an uptrend. And every single time it touched the 20 MA, if you went long, you would have made money, right? Just so it's a little bit clearer. Every time it touched the 20 MA, if you went long, you would have made money. Every single time during this uptrend. And that's exactly why I used the 20 period moving average. I'm not saying you should have went long. I'm not saying every single one of these pullbacks, every single buy setup here is a quality setup, but if you just bought it every time it hit the 20 MA, you would have made money. This is actually a chart of Bitcoin at $30,000. I think this was like the 4-hour chart or maybe the daily chart. I don't even need to explain it, what's going on. It's simple enough for any beginner to look at this and immediately understand what's going on, right? Let me get the pen tool. We moved up, then we kind of retraced and then consolidated into the rising 20 MA, right? What's the 20 period moving average doing? It's under price, trending higher, under price, trending higher, under price, trending higher. You guys get the idea. As soon as it hit the 20 MA, breakout. Did the same thing, based directly into the 20 period moving average, literally touched it, boom, massive breakout. So in this case, how would I enter the trade? So for a breakout like this, I would either enter above the base right here, or if you want extra confirmation, you could enter above the base here. And then where's your stop loss? Below the base. And I mean, it would have made you a ton of money. Very high reward to risk trade. And this is why I use 20 MA. It's simple, but it is a game changer during uptrends or downtrends, during trending markets. And I would argue that we as traders should only be trading during trending markets. It's super cliche, but the trend is your friend. Why would you trade in a sideways market when there's no clear direction? I want to trade in the direction of the trend. The markets are telling me, hey, I'm going in this direction, whether it's higher or whether that's lower. I identify that and I think to myself, okay, cool. The markets are telling me prices are higher. We're in a trend. I want to go in the direction of that trend because the probability that I'm going to make money increases because I'm trading with the direction. It's like if you're driving on the highway, would you want to drive with the flow of traffic or against the flow of traffic? Well, if you drive against the flow of traffic, you're probably going to crash into a car. It's dangerous. The same thing applies for trading. Why would I try to catch the top and go for reversals when I could trade with the trend? Now, I still do trade reversals. However, they are inherently more difficult than trading with the trend. I see way too many beginners that only trade reversals. It's like you guys are making it harder for yourself. Trade with the trend, and once you get a little bit better as a trader, once you have a little bit more finesse, you know what you're doing, you have more experience, you have more reps, that's when you can begin getting aggressive with reversals. All right, hopefully all of that makes sense. Now, like I just showed you, I trade either breakouts or retracements, and that's how I use the 20 period moving average. And what you want to do is time your entries when prices are either at or near the 20 MA. They don't need to be like literally touching the 20 MA for you to position yourself in the trade, but they have to be at or near the 20 MA. So that's a rising 20 MA if it's an uptrend, like we have right here, rising 20 MA. We want to be buying at or near the 20 period moving average, right? And the opposite applies during a downtrend. You have a downtrend, we want to be buying, or in this case, shorting at or near the 20 MA, right? In this case, it perfectly touched the 20 MA, but you're not always going to get that. And then there's, and that begs the question, why? Why do prices need to be near or at the 20 MA? Because there's this concept called extension. The way you can think of this is the greater the distance between price and the 20 MA, that is known as extension. You can think of extension as overbought if it's like, in an uptrend going, if it's moving up, or oversold if it's in a downtrend. We don't want to be buying or positioning ourselves when prices are extended. We want to be positioning ourselves when prices have corrected, when they're near the 20 MA. So you could use the 20 MA for that. You could use it for measuring how overbought or how oversold a stock or a crypto or Forex pair or whatever you're trading is, all right? And we ideally always want to be getting into it when it's near or at the 20 MA. So you could actually use this idea of extension, of prices being super far away from the 20 MA for reversal opportunities, like this right here. Like, take a look at this. Let me get the pen out and let me make it white so you could see it. Take a look at this. Look at how well prices have respected the 20 MA during the uptrend. Check this out, literally perfectly. Every single time it touched the 20, it went up. If you went long every time it hit the 20, you would have made money, except right here. Notice how it started to kind of go parabolic right here. And all of a sudden we had extension between price and the 20 MA. This is when a trend is exhausted. When a trend is exhausted, that means the trend is beginning to end. Funny enough, that rhymes. But hopefully that makes sense. And the way you can measure whether a trend is exhausted is the distance between price and the 20 MA, right? So in this example right here, you could see that there's kind of distance between price and the 20 MA. And if you want to see what happened right after, well, I have that screenshot. This is what happened. That's when the trend ended and we actually moved lower, and then we ended up rolling over and kind of going sideways and almost actually starting a downtrend right after this, right? So as soon as the trend was exhausted, this is actually a really good opportunity to potentially catch a reversal and go short. So you could use the 20 MA for reversals as well, right? By identifying when the trend is exhausted and then positioning yourself going against the trend, because trend is exhausted, there's not enough buyers. If there's not enough buyers, we're probably going to see lower prices, and that's when we can position short. So in this case, I would probably enter underneath the lows of this bar as a short, stop loss over the highs. All right, I don't want to get too into reversals in this video, but hopefully that makes sense. Here's a really good example of that real fast before we hop into the more practical stuff. I don't want this video to be too long, but we made a massive move, right? The trend was kind of exhausted, massive distance between price and the 20 MA. And this is precisely where you can look to go and play the reversal and capitalize on prices moving up and catching this long. So hopefully that makes sense. So we usually want to do the 20 MA within an uptrend or a downtrend. However, you can use it during reversals if the trend is exhausted, if there's major distance between price and the 20 MA. Hopefully this makes sense. And let's go ahead and hop right into the real life examples. One thing that I definitely want to emphasize before we continue is that when you are trading within an uptrend, whether it's a breakout or whether it's a retracement, you're essentially trading the idea of price correction. The idea that if the market moves up significantly, right, we need to see a price correction before we can make another leg up. Like in this case, we moved up significantly, we retraced, and then we consolidated into that rising 20 MA. As we were consolidating, we were correcting. Prices were performing a correction before it was ready to run the next marathon and have the next move higher. And that's exactly what happened next, right? We moved up, the market ran a marathon, the market put the next leg up, it can't just continue higher forever. It needs to correct. It needs to rest. And that resting, that correction can either happen through a retracement or a consolidation. In this case, it happened through a consolidation into that rising 20 MA, and then we could trade the next leg up. So hopefully that makes sense. When we're trading within an uptrend, we're essentially trading this idea of price correction, this idea that once prices have finished correcting within that trend, we buy and we take advantage of the next move up if it's in an uptrend, or the next move lower if it's in a downtrend. Okay, so I have my Think or Swim platform up. I have the daily chart right here. I have the 2-minute chart. I have the 5-minute chart, and then I have the 15-minute chart. And a lot of you guys are probably wondering, okay, cool, I get all of that. Seems simple enough, but number one, how do you use it in practice? And number two, on which time frames do you use it on? And you need to understand that I use multiple time frames. This is called multiple time frame analysis, and we're looking for multiple time frame alignment. I'm not just using one time frame. Throughout the trading day, I am always looking at the daily chart, and then in the morning, I'm focusing on the 1 and the 2-minute chart, and then as the day progresses, I focus on the 5-minute chart and the 15-minute chart, all while looking at the daily and the hourly. I am constantly looking and analyzing my trades off multiple time frames because it gives me multiple perspectives of what's going on in that stock, and that gives me a better idea on whether that trade is going to make me money or not. It just deepens my analysis. I have a better perspective of what's going on. All right. So a lot of the trades that I'm about to talk about, I'm going to go through this relatively quick. I personally made money on this week, or I watched it this week, or it was on our favorites list in the morning this week. So these aren't like cherry picked examples from months ago. These were literally trades from either yesterday or Thursday. And this is how I used the 20 MA. So let's look first at the DCGO. Why did I focus on the DCGO yesterday? Well, number one, it was a really interesting gap down. On Thursday, it closed at around 230 right here. Zoom in. And then yesterday it opened at 190. The reason I thought it was interesting on the daily chart is because it gapped down underneath support, underneath the all-time lows, directly under support, and it gapped underneath this move higher. I'll probably make another video going more into gaps and how I trade gaps on the daily chart, but this is why I was focusing on it. And right off the bat, if you just look at the 2-minute chart in the morning, I mean, look at this. We dropped, and I'm gonna kind of zoom in here. Look at this just beautiful setup. We dropped, we kind of retraced, moved in, moved a little bit back down, and look at this consolidation. Beautiful base breakdown directly into the declining 20-period moving average. I went short right here, and I put my stop loss right above the base and caught this move lower. Beautiful, beautiful setup. Now, once again, look at, for example, the 5-minute chart, right? Even later into the day. And this was closer to like 12:30 to the end of the day. Look at how well prices are respecting the 20-period moving average, right? You can see it's just trading off of it. Look at the 15-minute chart right here. We moved down, we retraced, dropped it a bit, and we just based right into the declining 20 MA, and then we got the breakdown. And this trade right here, I think this ended up making me like $600. I couldn't get that much size because I couldn't get filled, but short under the base, stop loss above it. Like literally on this trade, 2 different really interesting setups that worked that completely just consolidated into that declining 20 MA. Beautiful on the DCGO. Let's look at another example. NVAX, this thing made me like $2,500 at the end of the day yesterday, right? This wasn't an interesting gap. It just started to move down. But what I really want to show you is this. Check this out. So this thing was consistently downtrending all day. You could see like on the 5, you could see how well prices are respecting the 20 MA. It's not completely declining, but it is more or less but you could see how well prices are respecting it. Now right here, it started to break down 20 MA overpriced. This is the 5-minute. Even on the 15, if you look at the higher time frames, when we got closer to here, right, it got closer to the 20 MA and it was getting ready to break down. Then I went to the smaller time frame. This is how I use multiple time frames. Look at this 2-minute base right here. I mean, beautiful, unreal. Like, look at this. It dropped, based right into that declining 20 MA on the 2, and we got this breakdown. I got like 14,000 shares right here, and I caught this move lower. Ended up making me like $2,500. Really, really beautiful trade. But you could see how I'm combining multiple time frames. Downtrend on the 5, respecting the 20 MA. Right here, it's way too extended from the 20 MA on the 15 and needed to consolidate and correct before it did this breakdown, right? Really, really nice. And then on the 2-minute, we got that 20 MA breakdown. Beautiful, beautiful, beautiful stuff. Next, we got the PLX, another really, really interesting setup here. All right, so let's kind of analyze it. What do we got? Nice gap down. Look at this. It closed at 289 the previous day. Next day opened at 240. Look at this massive move lower. And the gap was the catalyst for that move. And look at the 15-minute chart. We dropped, retraced, based directly into the 20 MA. You didn't quite touch it, but it was at or near. Remember I said near the 20 MA. Then we got the breakdown. And then honestly, just time ran out and it didn't make that next move lower. You look at the 5, look at this. We dropped, retraced into the 5-minute 20 MA, then we got another drop. But then the day ended. All right. Even on the 2-minute chart, you could see like it's how well right here it's respecting the 20 MA. This is why I use it. It's like multiple time frames are telling me the same exact thing. That's why I get so confident using it. Oh, the IOVA. The main thing that I want to show you is actually the 1-minute chart. This was right off the morning. Check this out right here. Check this out. We dropped. This was actually one of my top watches. And I tried to scalp this 3 times yesterday. First 3 of them lost money. I was down $700, and then right here it retraced right into that declining 20 MA, and right here it literally touched it. I went short at 94. I remember 94. I went short, and I caught this whole move lower. Made all of my money back plus another $1,200 on the IOVA. I think that was my NPNL on it. Let me check. Let's see. What was my NPNL on the IOVA? Yeah, $1,200 literally. All right, let's move on. So that was really, really nice. Let's look at, oh, this is another, this isn't even that high quality of a trade, but number one, look at the 5. Began the uptrend, rising 20 MA, retraced right into it, moved higher. Even look at the 15. We moved up, retraced right into the 20 MA, bounced right into the 20 MA, bounced, and we continued higher. Beautiful, beautiful setup. And hopefully this just gives you an idea of how you're using it. Look at this open. Open was my biggest trade yesterday. Take a look at the 2-minute chart and the 5-minute chart. By the way, this is a beautiful gap down as well under support. Look at this. Dropped, based right into the 20 MA drop, based right into the 20 MA on the downtrend. Amazing move. This made me over 4,000. And they open right here on the 2-minute. Same thing. We combined multiple time frames. Same thing. We based right into the declining 20 MA. It's the same things. You guys are seeing how freaking useful it is. Even the Kodak yesterday, which was really good. Look at this. We moved down, retraced, moved down, based at the lows, right into the declining 20 MA on the 15. And then we got the follow through and the breakdown lower. Had a really interesting daily gap as well. It gapped under 2 green bars, so it trapped all of the buyers from the last 2 days. Same thing with the 5. You can see how it's declining. The GMAD was one of my best trades in the morning, as a matter of fact. And if we look at this, I went short right here. And then you could see how well it respected that downtrend. But I went short, let me clean it up. Right here, when it consolidated into that 20 MA, went short and made money. Very good. Let's move on. CRVS, same thing here. Not even that great of a setup. But look, respecting the 20 MA on this 5-minute move higher, especially here. Really nice little retracement. And then here as well on the 15. Beautiful, respected the 20 MA. Not a high quality setup, but you guys get the idea. Lift. I mean, look at this lift. Power trend. This was a big gap up on the daily chart. I think it had earnings. Gapped up, right? So nice bullish catalyst in the morning. Moved up based on the breakout. And look at this. I mean, every time it hit the 20 MA, it moved up. If you just rode out this power trend, it would have made you money literally all day. Let's see, what else? The GoGo, same thing with this. Didn't quite hit the 20 MA, but this was a nice breakout. And then it respected the 20 MA as it was moving higher. We really want that 20 MA to be trending and not flat, right? Let's look at the CRVX, same thing here. I mean, all of these, if you just look at every time frame, it really respects the 20 MA. Even this actually got bought and then went climactic, was a nice short. I didn't take it. And then even on the way down, look at this, during the downtrend, perfectly respected the 20 MA. I mean, every single setup I'm basically showing you guys. It's the same exact thing. And this is what I do every single day in my trading. Now, I obviously don't just use the 20 MA. I have exceptional mastery of knowing the quality of the setups, what criteria go into a high quality setup. You can learn all this in my free 10+ hour course. Watch it in the description of this video. I also combine using level 2. I made a YouTube video about that. Obviously, with my knowledge on how to trade gaps on the daily chart, which are bullish or bearish catalyst for that stock. Gaps can occur because of all sorts of reasons. I also have a YouTube video about that. Watch it. So it's not just the 20 MA, but I'm combining the usefulness of the 20 MA with everything else that I know about trading, and it just creates way more higher probability setups. It is truly unreal, and this is why I use it. It's the only indicator I use. Same thing here on the ZIP. Based right into the declining MA, attempted to break down, not much follow through, but you guys get the idea. Insane stuff. Even this, CTMX, look at this. 20 MA starting to trend lower. This one's a little sloppy, but same idea, right? Hopefully you guys get the point. These were literally trades from the last few days that I was able to make money on using the 20 MA with my knowledge of setups, with my knowledge of order flow, and just knowing everything that I'm good at with trading. Combine it all and it creates really high probability setups. This is what allows me to make money, guys. It's what allows me to get results like this because I keep it simple, and you should too. Hopefully you found this video incredibly useful. Please leave a like, subscribe to the channel. I'm constantly posting really educational and valuable videos that you could actually use to make money with. Subscribe, like, leave a comment if you found this valuable. And if anyone who's watching is looking for a serious hands-on mentor that you could trade live with every single day, I will be transparent. I do have a mentorship where I help scale and coach traders from zero to making $10,000 to $50,000 per month. I had plenty of students that surpassed $5,000 to $20,000 this past week trading alongside of me, right? Like I made $11,000 or I guess $10,800 yesterday. I had plenty of students that hit anywhere between $500 to $7,000 with me just yesterday. If you're looking for a hands-on serious mentor that will work with you until you find success, there's a application below. I'm very selective with who I work with because I only like to work with dedicated, disciplined, and professional traders or traders who want to be professional. So fill out the application if you're interested, but make sure you also get started with my free 10+ hour course. And hopefully you found this very educational. I'll see you guys on the next video.
What is up, guys? Hope you're having a great day. I'm very excited for this section of the course because we are finally going to be going into some of the more exciting parts about trading, and specifically we're going to be talking about the 20-day moving average today. And a lot of people out there, they trade with different indicators. Some people use MACD, RSI, Bollinger Bands, and other super fancy indicators, and frankly I don't use any of those. I keep my trading extremely simple. But one of the main, I guess you can call it an indicator, one of the main indicators I do use is the 20-day moving average. And we're going to talk about how to use it and how to really take advantage of it, because I personally believe it is the ultimate and most useful tool in trading, okay? So first, let me show you guys how to actually put it on your trading view charts. And let me turn off my camera. All right. So once you have this blank chart, you've selected candles right here on TradingView. You're going to go to indicators and you're going to type in moving average, and you could just select the simplest one. It's going to pop up here. It's going to say MA. Just go to this settings tab, go to inputs, and change the length to 20. And I'm going to make mine white. Okay. And there you go. The 20-day moving average is now on my charts, which is perfect. Now, let's go into how to actually take advantage of the 20-day moving average and how to use it. So, moving average. This is one of the fundamentals of technical analysis. This is, I would say, just as equally important as learning and understanding the candlesticks. It's just as important understanding how to use the 20-day moving average. So let's talk about what are moving averages. Moving averages, they are lines that represent price action in a particular time frame, okay? So if we're talking about, let's say, the 20-day moving average, that line shows you the average price within the last 20 days, right? If you have a 200-day moving average, which is another one that I use, that shows you the average price of that stock or crypto in the last 200 days. So it's calculated by taking the average of a set of prices over a specific number of days in the past. So like I just said, 20-day moving average, it would be the average price of the past 20 days. A lot of people also ask me about exponential moving averages. That's calculated through emphasizing more recent price action. So the equation that you use for an exponential moving average, it puts larger weight onto the most recent price action, and it's much more responsive to new information that's coming out with that stock or crypto. Okay, it just weighs more recent price action heavier in the equation. And it doesn't really matter which one you use. You could use either or, but just make sure you stay consistent with it. If you have the simple day moving average, right, make sure you keep that across all of your charts. And if you use exponential, make sure you use the exponential on all of your charts. So the moving averages, especially the 20-day moving average, it's the ultimate stock or crypto directional guide. It shows where a stock or a crypto is trending and how much momentum it has. So it's a directional guide, right? And specifically, I know a lot of people, they use the 10 MA, but I only use the 20-day moving average and the 200-day moving average. We're going to be talking about the 20 during this class. So let's talk about some key guidelines. A rising 20-day moving average is indicative of positive market strength, okay? That means it's bullish. There are more buyers than sellers. We want to see price and the candlesticks above the rising 20-day moving average, okay? That shows strength, positive market strength. A declining 20-day moving average trending lower shows negative market weakness. And in that case, we want to see price below the 20-day moving average, and that would show bearishness or a negative, it would show market weakness. The sharper the slope of the moving average, the stronger or weaker the trend is. And we're going to look at examples of that. During a bullish uptrend, right? We know what an uptrend is now. During a bullish uptrend, stocks tend to retrace or pull back to the rising 20-day moving average. That's why we want the 20-day moving average above price, because during bullish uptrends, we see price actually pull back or retrace to that rising 20. During a bearish downtrend, stocks, they tend to retrace or rally to the declining 20-day moving average, right? So during downtrends, they retrace to the declining 20-day moving average. So whenever you hear the term extended, when price is extended, that means price is far away from the trending 20-day moving average. So if I ever say extension or extended, it means price is far away from the 20-day moving average. There's distance between price and the 20 MA. And in general, guys, always trade in the direction of the 20-day moving average, especially if you're a beginner. Trade with the trend. Don't go against the trend. So this is an example here where we have a rising 20-day moving average and it is under price. You could see that the candlesticks are over price. Or I'm sorry, the candlesticks are over the 20-day moving average. And we can see that during a bullish uptrend, right, we have higher highs, higher lows. Price tends to retrace or pull back to the rising 20-day moving average. And then from there, it increases again, pulls back to the 20-day moving average, increases again, pulls back to 20-day moving average. Okay. And so my question for you guys is, can you find the different types of candles that we've learned about? Narrow range bars, tails, or igniting bars. Take a look at this chart and try to pinpoint some of the different candlesticks we've learned about. Go ahead and pause the video and just try to write them down. I'll give you guys a second to do that. Okay, so what we have here is we have a clear topping tail right here, right? Huge tail. The sellers have taken control, price then dropped. And then we have right here an igniting bar, right, where the opening price is near the lows, the closing price is at the highs, and it ignites a new move higher. We also have one here, right? Ignites a new move higher. And then right here we have two narrow range bars, which, you know, are kind of our entry bars in this uptrend. And we're going to talk about entry bars later. Okay, but if you were able to identify these candlesticks, then perfect. You're doing great so far. Let's look at the 20-day moving average when it's declining. Remember, when we have a falling or trending, a falling and trending 20-day moving average that's, you know, trending lower, we see that price is under the 20-day moving average, and whenever price drops, it usually retraces to the declining 20, drops, retraces to the declining 20, drops, and then now we could see that in this case it based into the declining 20. So the 20-day moving average for both uptrends and downtrends, they can be kind of used as also support, right? It's kind of acting as support for the stock during an uptrend, and it's acting as resistance for a stock or crypto during a downtrend. Hopefully this all makes sense, guys. This is a sideways trend, right? It's kind of fluctuating between highs and lows. Whenever we have a sideways trend, we also usually have a 20-day moving average that is flat and moving through price, meaning there's no noticeable trend that's taking place. And usually, guys, whenever you have a flat 20-day moving average, it shows that there's a lack of trend, and you should avoid that. So don't trade. If you see a flat moving average, it usually suggests that there's no momentum, there's no clear trend, and you know, you generally want to stay away from stocks or crypto that are not trending, right? The whole point, if something's trending, it has momentum, meaning we could take advantage of big moves higher, or we could short, you know, big moves lower. Okay, let's look at some examples. You could see right here, this is the 20-day moving average. We are trending higher, right? We are under price. You could see that every time price touches the 20-day moving average, every time it retraces to the 20-day moving average, it goes higher. So if you guys were to buy it every time price touched the 20-day moving average or got close to it, you would have made money. And once we go into the strategy section of the course, we're going to actually use the 20-day moving average and create a strategy, right? And the strategy is, you know, whenever it comes close, whenever it pulls back to the 20, that's what we buy. It's called a buy setup. We're going to be talking about that later. Okay. In this case, we have a declining 20-day moving average, this blue line. You could see how it's overpriced, and you could see that, you know, price touches the 20 and drops. Prices the 20 touches the 20, drops. Bases into the 20-day moving average, drops. Bases into 20, drops. So you could see that the 20-day moving average is acting as resistance here. And it's declining, it's trending lower, and we would short it every time it touches the 20-day moving average. Let's look at another example. You could see how well price is respecting the rising 20-day moving average, right? Right here, base, right? Right, as soon as it touches the 20-day moving average, it breaks out. Same thing here, as soon as it touches, breaks out. And the main point here is that we could see that it's trending higher and it's under price. Okay. Slope and extension of the 20-day moving average is significant, and we have to remember slope, right? That is the measure of steepness of a line, right? So if you guys have ever taken math classes, I'm sure you guys have calculated the slope for different math questions before, but we got to remember 20-day moving average is a line, right? When we measure the slope of it, we measure how steep it is. So we want to, you know, ideally we have something that's 45 degrees. 45 degrees is ideal because it shows that it's sustainable, right? The move is sustainable. the uptrend is sustainable. If it's higher than 45 degrees, right, where if it's kind of like, this is more or less 45 degrees, but if it's even steeper than this, then it shows that the current move is not sustainable. If it's less than 45 degrees, then it's going to be on the more flat side, and it's going to lack momentum. We talked about before how we want to avoid trading flat moving averages. Flat moving averages, specifically for the 20 MA, when it's flat, it shows lack of momentum. We don't want to trade stuff that doesn't have momentum. And the distance or extension between price and the 20-day moving average tells us if it's overbought or oversold. So let's go into it. You could see we have a solid uptrend. The moving average is it's not quite at 45 degrees, so it's a little bit flat, but still price is respecting it. And you could see how it's getting steeper and steeper and steeper. And eventually we have a large distance between the candlesticks and the moving average. Right here, this is extension, right? This is distance between price and the 20-day moving average. And you could see that the moving average was getting steeper and steeper and steeper. And eventually this move was no longer sustainable. And we ended up, I remember, dropping after this. And you could see how well price is respecting the rising 20-day moving average. Same thing here. I believe this is on Bitcoin. We broke out here, 20-day moving average trending higher. It's underpriced. Touched it here, popped. You could see every time it retraces to the 20, it continues the uptrend. And right here is when we have extension. So this is where you would want to look for a short position, right? We have extension from the 20-day moving average. And you could see the steeper it got, the less sustainable the move was, and we ended up dropping and starting to go sideways here. Okay? So look at another example. Same thing here. We're uptrending. The 20-day moving average is underpriced, trending higher. Every time price touches it, it rallies. You can see how well it's respecting it. Here it got a little steeper. You could see right here, it starts to get steeper. Then we have extension, right? We have distance between price and the 20. Here we don't really have any distance. Every time we have distance, it pulls back. But here we have pretty significant distance and extension. And then we ended up dropping from there. Okay, so we would look for a short in this position. Another example, you could see how well it's respecting the 20, and then you can see the 20 is getting steeper, steeper, and steeper. And from right here, this is no longer sustainable. This is where we're going to be looking for a short, especially with the extension that we have. Okay. So another very useful way to use the 20-day moving average is for spotting price transitions. When stocks or cryptos are ready to transition into an uptrend or a downtrend, the moving average will begin to curl and hug under price for a transition higher, or curl and hug over price for a transition lower. This is really effective for the larger time frames and for longer term trades or swing trades. And usually the time frames you're going to be looking at is the hourly, daily, weekly, or monthly. Let's look at some examples. As you can see here, this stock, I believe this is actually AMC. This stock is sideways, right? We don't have a clear trend, right? It's not really going anywhere during this time period. You could see the moving average is flat and moving through the candles, through price, until right here, you could see that we have a rally and the candlesticks were halted by the curling 20-day moving average. They stopped here, and that's when we had the breakout, the price transition. As soon as we started curling under price and pointing higher. Same thing here. When the 20-day moving average is trending higher, you could see prices respecting it. But as soon as the moving average becomes flat and moves, moves into price, through price, we could see it doesn't respect it until right here. We see prices starting to respect it. We're seeing it curl higher, and that's when we get the breakout and we go higher. So you could see that right before these big breakouts, the 20 MA is curling under it and starting to point higher. Let's look at PRTA. This is a really good example where PRTA, we could see that the 20-day moving average is starting to curl under price, right? Starting to curl under and point higher. And we could see that this is clearly a price transition. And this is the monthly chart. So each one of these candlesticks represents a month, and that's where we had the big breakout as soon as it started curling under price like that. But if we go to the daily chart of PRTA, so every one of these candlesticks represents a month. If we go into the daily chart, right, then we see something a lot more interesting where when the moving average is going through price, it's flat. We don't have any moves, but as soon as it starts to curl higher and under price, that's when we get the transition higher. Okay, same thing here. Soon as it moves under price and curls higher, that's when we make a move up. Same thing here. It's flat, trendless, nothing's going on. Right here, it starts to respect the 20 MA, it starts to curl higher, and that's when we have the breakout, right? And you can see as soon as it started trending, that's when we started continuing higher. And okay, this is the last slide. So trade with the trend, guys. Your odds of success are greatly increased when you're playing in the same direction of the 20-day moving average. The correct entry is when price is at or near the 20-day moving average, not when it's far away. Let me show you an example of that, right? So we want to be buying it during this uptrend when the moving average is below price. We want to be buying it when price is at the 20 MA, because when it hits the 20 MA, it goes up. When it hits the 20 MA, it goes up. When it hits the 20 MA, it goes up. So we want to be buying it when it's at or near the 20-day moving average. Just like we want to be shorting it when it's at, right? Rallies into the 20, we short. Rallies into the 20, we short. Goes into the 20-day moving average, short. Goes into the 20, short. Okay? And as soon as we see some price extension, that's when we begin to rally because we're extended. Okay? Hopefully that makes sense, guys. Let's go. And the 20-day moving average becomes extremely useful when you pair it with tradable patterns and strategies. So we're going to be combining this 20-day moving average with a real trading strategy later in the course. So you don't want to just enter because you have a rising or declining 20-day moving average. You want to have a pattern. And there's specific things we look for in that pattern when you combine it with the 20. We're gonna talk about that a little bit later. Okay, so main points here is that it's an excellent directional guide and it shows you what's going on with the trend. If we have a uptrend, we want the 20-day moving average under price and trending higher. If we have a downtrend, we want the 20-day moving average over price, trending lower. If it's sideways, it's not really that effective. Okay, that's kind of the summary here. Make sure you kind of watch this class a bunch of times. And my biggest recommendation, guys, is go and put the moving average, the 20-day moving average, right, on some of your charts and just start watching, how price actually respects it during uptrends or downtrends. Okay, and you'll just watch how price really trades off of it, and that's what makes it such a powerful and useful tool. So make sure you do that. And this was an excellent class, guys. Looking forward to seeing you guys in the next one. Thanks.
Let's hop right into the video. So step number one, you're going to go to indicators on your trading platform. Right now, I am on tradingview.com. Now, for my own personal day trading, I use Think or Swim. Now, you're going to see tons of different complicated looking indicators. You're going to see crazy names like the Shande Kroll Stop. You're going to see Elder Force Index. You're going to see like Williams Alligator, and you're going to be overwhelmed. You're going to be confused. Which one do you actually use? And you're going to want to actually ignore all of these fancy sounding indicators. And your goal is to keep things simple. So what you're going to do is look up moving average. Okay, you're going to look up moving average and you're going to see all these different types of moving averages. Now, what you want to do is double click on simple. You're going to click it once and then you're going to click it one more time. Once you do that, you're going to see these two moving averages pop up in the top left, and you want to hover over one of them and you want to go to settings. And once you do that, all you need to change is you want to change the length of 9, change it to 20, and then press OK. Now go to the other one and do the same exact thing. Hover over it, go to settings, and from here change the length to 9 And this time you're going to change it to 200. And voila. These are the only two indicators I have ever used in my trading. Now, I also use volume. I don't really consider that an indicator, and I'm gonna make a separate video on that, so make sure you subscribe to the channel to watch that video as well. But I've only ever used two simple moving averages. I think the simplest things in life are oftentimes the most brilliant. I have never used MACD, I've never used stochastics or VWAP or RSI or Elliott wave theory or Fibonacci. I keep it simple. And a lot of you guys are gonna watch this video and be like, oh my God, two simple moving averages? Like what? Like I thought you would be using all these complex tools. No, I don't use any fancy indicators. I keep it simple. And funny enough, these are two of the most powerful indicators you will ever use in your trading, and I'm about to show you why. Finally, let's talk about the 200 period moving average, and this is actually even simpler. So what we're looking for is for a flat 200 period moving average. The 20 MA, we wanted that to be trending, whether it's uptrending or downtrending, and we don't want the 20 MA to be flat. It's the opposite for the 200. We want the 200 period simple moving average to be relatively flat. And the 200 MA could act as a ceiling for price whenever prices are trading below it. It could also act as a floor for prices whenever prices are trading above it. So what does that mean? Let's say you have a bunch of price action right here. This 200 MA could act as resistance for this price action, where a lot of time prices will go to the 200 and bounce from it, go to the 200 and bounce from it. So it could actually be a resistance area for prices if prices are below the 200. Now, the same exact thing applies if it's support, if prices are trading above it. Let's say you have a bunch of price action. This 200 MA can act as support for price, where prices will actually bounce from it. And it's literally like a floor for price action. Now, this setup is quite rare. However, I do want to mention it. Every now and then, you'll get what's called a squeeze play, where you have a flat 200 period moving average, and then you have a 20 period moving average that is rising and going through this 200. And what you'll sometimes notice is prices will actually oscillate between the two, where it's going to use the 200 as a ceiling, as resistance, and it's going to use this 20 MA as support, and they'll continue to oscillate and oscillate and oscillate and squeeze until the point where it can't squeeze anymore, and it's just going to break out. And these setups are quite rare. However, they're extremely powerful. So you want a flat 200 MA, rising 20 MA that's going through the moving average, and you want to see prices oscillate between the two until eventually they can't, there's no more room to oscillate, and then they break out. And this honestly works better for like swing trading. So I'd look at the daily or weekly time frame for this. Alrighty, let's look at some fantastic examples on how you could apply the 20 and the 200 MA into your trading. And I'm going to give you my thought process on how I apply it in my own trading. And by the way, these are not like cherry-picked examples. These are all stocks that I was watching or that I traded this past week. Like this KDP, this is Keurig. This had an overnight gap down yesterday where it gapped from $35 and the next day it opened at $32.50. And notice how we gapped directly below the 200 and how we opened below all of this support. So I was going into yesterday with a bearish bias, and I actually really like gaps that open below the 200. But let's take a look at the 5-minute time frame. This is one of the main time frames that I use, and look at how well prices are respecting the 20 MA on the 5, especially as soon as the 20 MA starts to actually establish a downtrend. As soon as the 20 MA is trending lower, right here basically, notice how well prices are respecting the 20. So right here, this is a potential short opportunity directly under the base. Dropped, kind of based into the 5, not quite, dropped again. Look at this, consolidated directly into the 20 MA and the 5. Next day, we gap down a little bit and continue that downtrend. Now, this is the 5-minute. Let's look at the 2-minute, especially today. And this is going to be shocking, but look at this. Look at how well prices are respecting the 20 MA on the 2-minute. I mean, every time it hits the 20 MA here, here, right here, right here, right here, every time it hits the 20 MA, and it ends up dropping. And you could have literally went short every time prices hit the 20. And it would have worked for this absolute beauty of a power downtrend. And this is why I use the 20 during established downtrends. Notice how the 20 MA is trending lower very, very strongly. If we look at the 15, it's basically the same thing, where the 20 MA is trending lower. However, there's a little bit of distance between price and the 20 MA. So the 20 MA isn't being like fully respected on the 15-minute chart. From there, you go to the smaller time frames to find your entries, but unbelievable daily gap that led to a beautiful downtrend where you could use the 20 MA for your entries to capitalize on this trend. Let's look at the BNS. This is a random stock that popped up today. This is the Bank of Nova Scotia. And stemming back all the way from 2024, when this uptrend kind of reversed, you could see that we entered into a downtrend on this stock. And this is the daily time frame, by the way. Look at how well prices are respecting the 20 MA on this downtrend. The 20 MA is overpriced, trending lower. We drop, retrace into the 20. Drop, retrace into the 20. Here we actually gapped down like 8%, and it gapped right into the 200 MA on the daily time frame. So this 200 MA acted as a floor for price. It acted as support for price. We gapped right into it, instantly got bought, then retraced into the 20, hit it perfectly, dropped. Again, hit it perfectly, dropped. And then right here, the trend reversed and we went into an uptrend. And you could see for yourself, look at how well prices are respecting the 20 MA. I mean, I don't even need to explain it. It's literally obvious and it's simple. That's exactly why I use the 20 and the 200 MA. Even here, we had a gap up today. Literally today, we gapped up 2% on a really bullish chart, really bullish trend on a nice gap up. Go to the 15-minute time frame to find a potential setup. And even on the 15, look at how well prices are respecting the 20. We have a nice rally. 4 red bar pullback, nice little buy setup here. We kind of move up a little bit right into the 20, and then we take off and make new highs. And this is why I use the 20 and the 200 on the intraday time frames and even on the larger time frames, because they're simple and they allow me to understand what the trend is. When I look at this chart, I know exactly what's going on. Established downtrend, then an established uptrend. And I know where I could potentially get into the trend using the 20-period moving average. Let's take a look at this RR, which had a really nice breakout the last couple days, but let's go back to 2024. And this is a really good example of a squeeze play where we have a rising 20-period moving average, flat 200-period moving average. You could see prices hit the 200, then hit the 20, then hit the 200, kind of oscillated back and forth. It's not a perfect example, but once it broke out, it really broke out. And this thing rallied like over 500%, which is insane. So that's a decent example of a squeeze play, but that's not even what I want to show you in this example. Look at how well the 200 MA is acting as support and as a floor for this stock. Like we hit the 200 here, instantly we bounce. Then we kind of chop around. We retest to 200, we bounce. Here we actually almost break down through the 200, that's instantly rejected. We move right back up. Again, we try to break through the 200, rejected. Again, right here, we try to break through the 200 to the downside, rejected. And then this time it led to a 62% move to the upside. And this is why I like to use the 200 MA. Whenever prices are above it, it acts as a floor, it acts as support. And by the way, this is the daily time frame. Let's look at a good example of using the 20 MA during the intraday time frame. So this stock had a very minor gap up. This was just a few days ago. It gapped up 2%, so it opened higher by 2%. It had a really nice green day. I'm seeing the 20 MA on the daily time frame is starting to trend higher. It's underpriced. So I went into this day with a bullish bias. And just take a look at this 5-minute time frame. Just beautiful uptrend, and it's beautifully respecting the 20 MA where we had a nice breakout here. We moved up, retraced to the 20, kind of chopped around, another move up, retraced to the 20, move up, retraced to the 20, move up, retraced to the 20. And it's just respecting the 20 MA almost perfectly. And every time it hit the 20, that was actually an opportunity to potentially go long. And just a beautiful uptrend with the 20 MA under price trending higher. Let's look at another example where we combine using the 200 MA on the daily time frame, and then we use the 20 MA on the intraday time frame. So this MAT gapped from like 2018, and the next day it opened 6% lower at around 1890. Notice how we gapped directly below the 200, literally directly below it. We didn't gap into it where it would act as support. We gapped right below it. And we also gapped underneath a lot of this support as well. So beautiful gap down. And from there, we go to the intraday timeframes to find a potential setup. So off the 5 here, I mean, again, you could see how well prices are respecting the 20 MA. The best setup was right here, stop loss above basically. So this is the 5. Even if we look at the 2-minute, again, every time prices hit the 2-minute 20 MA, we get a move lower. We drop, retrace to the 20 MA and the 2, drop. Then right here, notice, check this out right here. We attempt to break above the 20. We attempt to kind of end this downtrend, break over the 20. That was rejected. Then we continue to base. The 20 acted as resistance, and boom, we got another breakdown. Again, right here, attempt to move past the 20, breakdown. Attempt to kind of go through the 20, breakdown. And you could see how well prices respect the 20 MA during this established downtrend on multiple time frames. Even if we look at the 15, right? It's usually better to look at the smaller time frames for your entries into these day trades, but even on the 15, 20 MA is overpriced, trending lower, confirming that bearish downtrend. This is Coinbase from a few weeks ago. We have a rising 20 MA under price. We have a consolidation into that rising 20 MA. 200 MA is directly above. We gap above the 200, around 12% to the upside. Gap above the 200, triggering this base breakout on the daily time frame. 20 MA is under price. You go to the 15-minute time frame for a potential setup, and beautiful uptrend. Let's look at the 5. And you could see, look at that 5, how well prices are respecting the 20 MA. We have that initial move up, we consolidate directly into the 20, breakout over the base, nice move up, retracement into the 20. Look at how well it's respecting the 20, and then we have another leg higher. We retrace, another move up. So you could see how well prices respect the 20 MA, and this is exactly why I use it on multiple time frames. Let's finish off this video by looking at the S&P 500, the SPY. So this bottomed out in April, and since then we have been up only. And during this uptrend, what do you know? Look at how well prices are respecting the 20 MA, even on the SPY. So we have a nice move up, retrace into the 20. Nice move up. Here we consolidate into it. Then we have another breakout from the 20. We try to retest it on this tail. Instantly we move up. Here we actually broke under the 20. This was a few weeks ago. We broke under the 20, instantly rejected, have another nice move higher. Here we have a retracement, nice buy setup into the 20, boom. And now it looks like the SPY wants to continue higher. We could even look at like crypto. Let's take Ethereum. Look at how well Ethereum is respecting the 20 MA over the last few months. We have a rising 20 MA under price. Here it kind of broke below, instantly rejected, and we had a nice move higher. We retraced right into the 20, literally hit the 20, instantly we popped. Another red bar, hit the 20, boom. The next day we have a nice green bar. This was on the Jackson Hole, Jerome Powell speech. Then we retrace, hit the 20, boom. Today, literally another green bar. Even if you look back, just a few months ago, I bought a shit ton of Ethereum right here because I saw that the 20 MA started to transition higher. It's curling up. The 20 MA is underpriced, trending higher. We have a nice move up, base into the 20. This was a beautiful breakout. And what do you know? It hit target at the 200. So the 200 acted as a ceiling for Ethereum, where it hit the 200, retraced, hit the 200, retraced, hit the 200, retraced, hit the 200, retraced. Here we broke through. We kind of had a fake out and then a fake out to the downside. 20 MA is flat, so it's not that useful. And then as soon as the 20 MA begins rising and trending under price, that's when Ethereum starts respecting it and it resumed the uptrend. And I'm still expecting much higher prices for Ethereum. And that is exactly why I use the 20 and the 200 MA for every single one of my charts that I look at. I like to keep it simple, guys. All I use are two moving averages, the 20 and the 200. And by keeping it simple, that's what allows me to make money. So hopefully this could be transformative for your trading. And hopefully this will help you keep it simple. So make sure you subscribe to the channel if you enjoyed this video. Leave a comment if you found it valuable. Leave a like. That's going to help the YouTube algorithm. And hopefully you learned a lot. And I will see you on the next video. Thank you very much.
What is going on, guys? Glad that you've made it to this section of the course. And today we're going to be talking about multiple time frame analysis. And I've mentioned this in previous classes, the importance of using several different time frames while you're trading. And that is an extremely important concept. In fact, I will say that it is probably one of the biggest beginner mistakes that I see is that traders are not using multiple time frames when they're analyzing a specific stock or crypto. They're only using one time frame, and then they're making bad decisions from it because they're not considering the overall context, overall landscape of what's going on with that stock, right? So let me turn off my camera here, and we're going to get into multiple time frame analysis. So key concept here, guys. Like I said, like I just mentioned, not checking multiple time frames when you're trading, one of the largest beginner mistakes you can do. You are literally trading blindly if you're only considering one time frame prior to taking a trade. You really are. And the probabilities of a trade working in your favor significantly increases when there is multiple time frame alignment. When several time frames are all saying the same thing about a stock or a crypto, that's when you could look to take advantage of a potential move either higher or lower. And you don't want to take trades where there's a conflict between the time frames, right? So let's kind of talk about that. So what is multiple time frame alignment? It means it's when, several time frames are aligned. They're all saying the same thing. They're either all saying that it's bullish, or they're all saying that it's bearish, or they're all saying that, oh, there's no momentum, it's actually a sideways trend, okay? So let's go over one example here. The daily chart is bullish, it's uptrending, and the 20-day moving average is trending higher and is underpriced. The hourly chart is also bullish with a rising 20 MA underpriced, right? The 15-minute and the 5-minute are also both very bullish with rising 20-day moving averages. And the 15-minute chart also has a breakout pattern, which we haven't learned about that yet, but we will learn about that. So it also has a beautiful breakout pattern, right? So let's compare this example to example number 2, where the same thing, the daily chart is bullish, it's uptrending, the 20 MA is rising and trending underpriced. However, the hourly chart has a declining 20-day moving average that's curling overpriced, right? And remember, when it's declining and when it's curling overpriced, that suggests, bearishness. It suggests that prices are going to go lower. The 15-minute chart is sideways and has a flat 20-day moving average. And remember, when it's flat, that means it's trendless. There's lack of momentum. And the 5-minute chart, however, looks bullish with a trending 20-day moving average that's underpriced. Which trade has a higher probability of succeeding, right? The example 1, where every single time frame, doesn't matter if it's the larger time frames, such as, going at the daily or hourly chart, or the lower time frames, that's the 15-minute or 5-minute chart, all of them are screaming bullish. All of them are giving you the same information that the stock or crypto looks higher. Or are you going to choose example 2, where you have one time frame showing higher, another time frame showing lower, one time frame showing that there's no momentum at all, and then this time frame saying that it's higher, right? You could see that we don't have multiple time frame alignment in example 2. And we would prefer seeing example 1. So you can quickly see the importance of having multiple time frames all giving you the same information. And here we have a great example of conflict between the time frames, right? We have different time frames telling us different types of information. Okay, so obviously example one has the higher probability of succeeding. So let's talk about what time frames you should actually be looking at. And we're going to be talking about crypto day trading first. So something to note, crypto markets are 24-hour markets, meaning they don't close. They operate on a 24-hour schedule. There's always buying and selling in the crypto markets. So step one, always check the higher time frames, meaning the daily and the weekly charts, to see the overall context on how the crypto is trading. You're looking at the larger term or longer term trend, right? Step two, you're going to move on to the hourly chart, see what's going on there. And then step three, you're going to go to the 5 and 15-minute charts. And if you're scalping, which is taking really short trades, really quick trades, then you're going to be looking at the 1 or 2-minute charts. So the point is here, guys, we're starting at the larger time frames and we're moving to the smaller time frames, right? We're seeing what are the larger time frames telling me, and then we're going to go to the smaller time frames and see if those time frames are telling you the same thing, and if we could potentially find a strategy or an entry. Okay, so hopefully that makes sense. For stock day trading, it's a little bit different because the stock market in the U.S. equities market is open from 9:30 a.m. to 4 p.m. Eastern, and that's Eastern time, okay? So as a result of that, there are going to be price gaps that occur, and we're going to be talking about price gaps a little bit later, but just know that in the U.S. equities market, it opens and closes at a specific time, okay? So step one, what you're going to be doing is always look at the daily chart first to see if the stock is gapping and for overall context on how the stock is moving. So once again, we're starting at the larger time frames. Then you're going to move to the hourly chart for further context to see if you can get any information from that, to see if the hourly chart aligns with the daily chart that we did in step one. And while you're keeping an eye on the higher time frames, and this is of course Eastern time zone, from 9:30 to 10 a.m. you want to be looking at the 1 to 2 minute charts. From 10 a.m. to 11:30 a.m. you're going to want to be looking at the 2 minute and the 5 minute charts. And from 11:30 a.m. to 4 p.m. you want to be looking at the 5 minute and 15 minute charts. Okay, so just write this down and keep these time frames in mind. But even if you're trading at, let's say, 2 p.m. and you're looking at the 5 and 15 minute charts, you want to always have a look at the daily chart to see if it's gapping and what's going on with the daily chart, right? What overall trend is seen, and how is it trading? For crypto and stock swing trading, number one, you're going to want to look at the daily chart and the weekly chart, okay, and identify potential setups. So go to the daily and the weekly chart, see what's going on, see how it's overall trending, try to find specific setups. And step two, then look at the hourly to find potential entries. So once you found the strategy or the setup that you're playing on the daily or the weekly chart, then go to the hourly to find some potential entries so you can take advantage. Okay, so main time frames are the hourly, daily, and weekly charts. Okay, so now we're going to practice. Now we're going to analyze some more stocks and crypto for you guys, so you guys can get the hang of it on how to practice multiple time frame alignment. And we're going to be kind of showing you what it looks like when multiple time frames are aligned, and what it looks like when we actually have conflict between the different time frames. Okay, so hopefully this all makes sense, guys. This is a very, very important topic. Okay, so please make sure you're always looking at different time frames. Okay, and just follow the framework that I set. Always start at the larger time frames and then move to the lower time frames. And when you have the larger time frame saying bullish, and then you have the smaller time frame saying bullish, and the 20-day moving average looks good, and the 200-day moving average looks good, and you have an actual playable pattern, which we're going to learn about soon, then you could actually take the trade and make some money off of it. But you could see the multiple time frame alignment part of it is key. It's crucial that all of the time frames are telling you the same information. It increases the likelihood of success for that trade. All right, guys, we're going to do a practice session next. So see you then, and we're going to actually learn how to do this, not just in theory, but in practice as well. So thanks, guys.
In this video, I'm going to completely reshape the way that you look at time frames. And what if I told you that I don't actually use one specific time frame for all of my trades? And to show you how you should perceive using time frames, we're going to use an analogy. Imagine we have a mountain right here. And let's say you are at the bottom of the mountain. This is you chilling. You're at the bottom of the mountain. I have a question for you. Are you truly going to have a perspective of what's going on around you when you're at the bottom of the mountain? Like, are you going to understand what the landscape is around you, where the hills are, where the birds are, where the creeks are, the lakes, the rivers, whatever? Are you going to have a perspective of what's going on around you? Well, not really. You're literally at the bottom of the mountain. Like, imagine being at the bottom. You can't really see what's going on around you. But as you move up the mountain, right, let's say you're right here, are you going to have a better perspective of what's going on beneath you at this point of the mountain? Well, absolutely. You have a much better perspective. You could somewhat see the landscape, the trees, the lakes, etc. You have a better perspective than when you were at the bottom of the mountain. Now, let's say you're at the top of the mountain. Are you going to have a better perspective? Well, of course. In fact, you're going to have the ultimate perspective of what's going on beneath you and around you because you're at the top. You see everything that's down below. You know what the landscape is. You know where the rivers are. You see everything because you're at the top of the mountain. You have the ultimate perspective. And this is the way that I would perceive and understand time frames. When you're at the bottom of the mountain, that's like looking at smaller time frames in your trading. And then as you move up and up the mountain, that's like looking at the higher, the larger time frames in your trading, where the larger time frames, they give you perspective on what that stock or what that crypto, whatever you're trading, whatever it is doing. It gives you the ultimate perspective. It gives you the kind of long-term bias of what's going on. And then as you go down the mountain, you could, your perspective kind of shrinks and shrinks and shrinks. And this is the way that I would think about time frames. And the point that I'm trying to make here is it's not about using one time frame. There are so many videos on YouTube that will tell you use exactly these time frames and you'll find success. No, that's not what trading is about. Trading is about multiple time frame analysis, right? And this is one of the biggest mistakes that most beginner traders make. They don't look at multiple time frames before they enter into a trade. And frankly, you are trading blindly if you're only considering one time frame before taking a trade. I want you to think about the last, let's say, 10 trades that you took. How many time frames did you look at before you entered into those trades? What were you just looking at the 5-minute chart or the 1-minute chart and you entered and then it ended up being a loser and you were like, why was this a loser? I want you to ask yourself, be honest with yourself. Are you actually looking at multiple time frames? And if not, why not? And what we're looking for when we're reading multiple time frames is alignment. Alignment. This is called multiple time frame alignment, where multiple time frames are telling you the same thing, right? They're all telling you what the stock is doing. They're not conflicting, right? So alignment would be like 5-minute is uptrending, 15-minute is uptrending, hourly is uptrending, daily is bullish. That's alignment. Conflict would be like 5-minute is in a downtrend, 15-minute is sideways, daily is in an uptrend, hourly is sideways. Like, that's not alignment, that's conflict, right? And we're gonna be looking at really specific examples of how this works, all right? So what I want you to focus on in this little example, in this exercise here, because this concept is actually extremely simple. Looking at multiple time frames is really simple. And don't worry, I will tell you what multiple time frames I use in my trading every single day. That's a little bit later in the video. This is equally as important. I want you to look at the current time frame in each one of these examples. And what we're going to be doing is considering and asking ourselves, are we going to take this trade on the current time frame based on what the lower time frame is doing and based on what the higher time frame is doing? So let's look at this first example. What's the current time frame? Well, it looks like we're in a very strong uptrend. We have a rising 20 MA underprice, and it looks like we have like a buy setup retracement pattern. This looks bullish. It looks like we want to go long on the current time frame. So let's think about, should we go long? What is the lower time frame doing? Well, the lower time frame is in a downtrend and looks bearish, okay? Looking like it's actually going to drop, declining 20. Higher time frame is essentially doing the same thing, right? In a downtrend, declining 20, bearish. Are we going to take this trade on the current time frame? Should be absolutely obvious. No, obviously not, because the lower time frame is bearish and the higher time frame is bearish. Makes sense? Easy enough. Let's move on. What about this situation? The current time frame, same exact thing. We're looking to go long for a buy setup, retracement play, strong uptrend. We want to go long and make money to the upside. Lower time frame looks good as well, almost identical. Bullish, uptrend looks good. Higher time frame is bearish and in a downtrend. I want you to pause the video. Are we going to take this setup? And the answer should be no. We're not going to take this setup. We always put more emphasis on what the higher time frame is doing. So in this case, the higher time frame is bearish. If the higher time frame is bearish, that's like the upward perspective, right? That's like the top of the mountain is bearish, right? And then the bottom of the mountain is bullish. Are we going to take this trade? No, right? Because the higher time frame is just way more important than the lower time frames. This is what gives you the bias. We always want to be trading in the direction of the higher time frame, all right? Makes sense? Should be easy. Higher time frames more important than lower time frames in terms of direction. Next, we have the current time frame right here. Bullish, looks higher, great. Lower time frame looks bullish, higher, uptrend, great. Higher time frame, bullish, uptrend, looks great. Perfect. This is excellent. This is exactly what I want to see, because the lower time frame is bullish and an uptrend. Current time frame is bullish and an uptrend. Higher time frame is bullish and in an uptrend. Excellent. This is obvious, exactly what we want to see. This is multiple time frame alignment. Now let's look at this example, and this is going to be interesting. Current time frame looks good. Uptrend, same exact, right? We want to go long. Higher time frame looks good as well, right? Uptrend, bullish, uptrend looks great, right? Current time frame and higher time frame looks great. Remember, we put more emphasis on the higher time frame. Everything's looking good. What is the lower time frame doing? Well, the lower time frame is bearish in a downtrend. So what do we do here? And you actually have two options. Your number one option is you could say, hey, I don't care about the lower time frame. The current time frame looks excellent. The higher time frame looks excellent. The longer term bias is on my side. I really like the quality of the setup. I don't care if the lower time frame is bearish, because the current time frame and the higher time frame looks good. I'm taking the trade. That's option number one. Option number two, you can be patient, maybe pass on the initial setup and wait for the lower time frame to turn bullish. Wait for this to end the downtrend and begin an uptrend, or wait for the 20 MA to start curling up, right? You essentially wait for the lower time frame to begin aligning, or you wait for the lower time frame to begin aligning with the current time frame with the higher time frame. Jesus, the words mix me up, but you guys get my point here, right? We wait for the lower time frame to begin looking bullish, and that will give us our final confirmation to go long. So those are your two options in this case, where the current time frame looks good, higher time frame looks good to go long. Lower time frame is bearish. You could just take the trade anyway because you like the current and higher time frame, or you wait for the lower time frame to turn bullish, wait for the 20 MA to begin rising, wait for the downtrend to end and for an uptrend to begin forming. Those are kind of your options, and this is the way I look at every single scenario, every single trade in the markets. Excellent. Let's go ahead and look at some real life examples. And this was actually a trade that I took the other day, or that I was considering taking the other day. So let's look at this EOSE on the 15-minute time frame. All right. What do we have? We have a declining 20-period moving average. Looks good. We dropped. We kind of retraced that drop. We moved down, and then we began basing into the declining 20 MA on the 15-minute chart, and we were gearing up for a breakdown. It looks like this wanted to break the lows of this base. That would be our entry. Stop loss above this pivot. It was looking good for a breakdown, right? I was actually considering this. Now let's look at the daily time frame. What do we see on the daily? Well, the day before, we had a nice gap down, big move lower. I actually made money on the EOSC this day. The next day, this is this day right here. So this setup is on this day right here. We gap down again, and then we attempt to move lower. Now notice how we have the 200 period moving average acting as support. So this is an example where the 15-minute time frame looks good to break down, looks good for a short, but the daily time frame is directly into the 200 period moving average, which is acting like support for this stock. And this is an example where we use multiple time frames. 15-minute looks good, but we have to check the higher time frame, which is the daily chart, and then we see that this stock is into support. So what was the outcome of this trade? Well, it didn't end up working. It actually ended up failing, right? It basically triggered, and then immediately failed, and it would have hit your stop loss. But that trade could have been easily avoided by just looking at multiple time frames, by looking at the current time frame and then looking at the larger time frame to see, do we have support below? What is the overall trend on the larger time frame? Does it look good or not, right? In this case, the overall trend was bearish, right? We had a gap down, we were continuing lower even on this day, but we had support at the 200. So the setup ended up failing, and I ended up avoiding this loss. Why? Because I looked at the higher time frame. I used multiple time frame analysis. Let's look at another example here. So this stock actually gapped up on this day right here, right? You could kind of see the 20 MA starting to curl under price. It looks like it's starting to form an uptrend, right? We have a low, high, low, high, low, high, right? We have an uptrend. And then we have a kind of like a retracement buy setup here. When we move up, we retrace. We ended up actually gapping right here, right? And I saw this on this morning, right? This was like last week. So on the morning, I saw that we were opening at this price around $27. This was before the market actually opened. So this was the pre-market price that I was seeing for this stock. So what did I do? I went to the daily time frame and I checked, does this stock have room to actually run? Where is the next resistance area if I decided to go long on this stock? And remember, I'm a gap trader. So as soon as I saw this gap up, it's kind of clearing this little resistance here, I was interested in potentially going long on it. And I looked to the left and I saw, hey, we have a bunch of resistance here. This is the next resistance area. And let's see how the trade ended up playing out. All right. And we ended up, moving higher. We had that gap. We opened right here. A gap is an overnight change in price. So you could literally see that there's a gap in price. Maybe, I think this happened because of earnings or some news. That's irrelevant. I only really look at the price action, but we gapped up. I saw that we had room to run to the next resistance area, and that's exactly where we ended up kind of finishing off that day's move. From there, once we established there was a gap on the daily time frame, the gap had room to run to the next resistance area. We go to the smaller time frames, in this case, the 2-minute chart, right? And we found a setup. We had a move up, retracement, and this is just a picture-perfect buy setup, picture-perfect retracement pattern, right? 40 to 60% retracement, multiple entry bars. Entry would have been over the highs of these doji bars. Stop loss would be below this bottoming tail, and we saw just an amazing move higher. And I actually teach the buy setup and this retracement pattern in my free 10+ hour course. It is genuinely better than most paid courses on the internet. I 100% recommend that you watch it. It'll actually build the foundation for your trading. It is 10+ hours of just pure sauce. Watch it and combine what you learn in my free education, in my free course, with everything that I teach on my YouTube channel. But hopefully you guys are kind of getting the idea here. I don't want this video to be too long. I kind of want this to be a rapid fire video for you to learn from, but hopefully this makes sense. We start off looking at the daily chart. We identify the gap, identify what the next resistance area is. It was a gap up above resistance, love it. Then I went to the smaller time frames to find a potential entry. In this case right here, I found an entry on the intraday time frame. I checked the larger time frame to see if it looked good, to see what the trend was, to see if we had support beneath us, and we ended up having support, and I ended up avoiding this trade, and I avoided losing money on this position because I checked multiple time frames. And this is kind of the system that you want to use. Now, let's go ahead and cover what time frames I actually use for trading stocks. And right off the bat, I am always looking at the higher time frames. For everything that I do, I'm always keeping an eye on the daily time frame and the hourly time frame for every single one of my trades. So when the market first opens, I am primarily focusing on the 1 minute and the 2 minute chart. And closer to 10 a.m., I'm definitely focusing on the 5 minute chart as well. Then from 10 a.m. to like 12:30 p.m., I'm focusing mainly on the 2 minute and the 5 minute, primarily really the 5, and then of course a little bit of the 15. As we move towards 12:30, I'm more and more looking at the 15-minute time frame, and then from 12:30 to 4 p.m., I'm mainly looking at the 5 and the 15 for my entries and for my setups. All right, and I do occasionally look at the 1 and the 2 minute charts as well, just for extra confirmation. And this is what I do. And I'm always looking at the daily and hourly, right? So it's in conjunction. It's not like only this time frame or only that time frame. We're looking at multiple time frames, and that's what gives me an edge compared to other traders. I'm really good at analyzing multiple time frames because every now and then you'll get a setup that looks amazing on the 5, amazing on the 15, even looks kind of good on the daily, but then the hourly will be into resistance, right? Or the opposite, maybe the intraday timeframes aren't that great. Maybe the 5 and the 15 are okay setups, but the hourly and daily chart have, a fantastic setup where it was a high quality gap up or gap down. The hourly chart looks amazing, but the 15 and the 5 don't look as good. Sometimes I'll still take that setup because of how good the higher timeframes are. Does that make sense? So it's really, I'm always emphasizing the higher time frames and the current time frames, all right? And don't get hung up on the exact time of day, right? It doesn't matter, like if it's like 9:57, that's not like, there's no like exact time where I transition to another time frame. It's kind of like flexible. I'm very free with my trading. I'm kind of looking at all of them, to be honest. In terms of swing trading, we're primarily looking at the hourly time frame, daily time frame, weekly time frame, or monthly time frame. Monthly time frames are a bit much, right? A lot of times you don't really need to look at the monthly. It's mainly hourly, daily, weekly. If you find a setup off the weekly time frame, you want to go to the daily time frame to find a setup. If you find a setup on the daily time frame, you want to go to the hourly time frame to find a setup, right? So let's say you find a setup on a particular time frame, on a higher time frame, you can go to the smaller time frame to find an entry for that setup, and this will allow you to find potentially a better entry, and you could also even get a tighter stop loss, right? So let me kind of show you an example of this. I'm gonna kind of draw it out. Let's say you have like a nice little uptrend and you get a buy setup, and let's say this is the 15-minute time frame. Maybe if you go to the 5-minute time frame, right here, you get, I don't know, a tighter stop where you can maybe put your stop here, entry there. But if you did it on the 15, your entry would be here. Does that make sense? So you're able to use a tighter stop and as a result have a better reward to risk. This is not the best example. I'm kind of just drawing off the top of my head, but you guys get the point, right? You see a setup, you can go to the smaller time frame to find an entry into that setup, find a stop loss into that setup, and as a result have a tighter stop and have better reward to risk. Right? Hopefully this makes sense. So sometimes if I see a really nice daily setup, I'll go to the hourly for my entry. I find a nice weekly setup, I'll go to the daily for my entry. So you could play around with this. You could use multiple time frames and get creative with your entries. In summary, guys, this concept is actually incredibly simple. Always look at multiple time frames, and this will allow you to filter out a lot of the low quality trades that you're taking, because I guarantee you're taking trades that look maybe amazing on the 15-minute time frame, but then when you look at the daily or the hourly, it doesn't look good at all. And maybe by using multiple time frames, that would save you from taking the trade and save you from losing money. Does that make sense? It's a really simple kind of concept, right? And these are the time frames that I use in my trading. And it's all about just using multiple time frame analysis and always looking for alignment. You always want, ideally, you want to see this. You want most of your trades, 80% of your trades, to look like this. Lower time frame is in sync, current time frame is in sync, higher time frame is in sync, everything looks good. There are multiple qualities that are converging together to make it a high probability setup, and you're probably going to make money most of the time trading this quality of a trade. And the other setups you should be taking are like this, where maybe the current time frame looks good, the higher time frame looks good, but the lower time frame isn't quite ready yet. In that case, you could be patient and wait for it to set up. And realistically, guys, unless it's like a small scalp, you should never really be taking setups when the higher time frame is in conflict with the current time frame and the lower time frame.
All right, today we are talking about support and resistance lines. And as traders, I'm sure you have heard plenty and seen plenty about support and resistance and how you could potentially use it to your advantage. However, during this class, I'm going to be teaching you exactly how I use support and resistance and some of the theory that you need to understand before actually applying it to your trading, okay? So what is actually support? What does it mean? So support can be defined as a price level or area, or you could think of it as a price zone where historical price action has shown that in that area, there's way more demand than supply. So in other words, in that area, there are way more buyers than there are sellers, okay? And when a stock actually hits support, you can either buy it, or you can either look to, buy it, or you can even look to short it, using support. And we're going to be looking at both of those examples. So the key thing about support is that in resistance, as a matter of fact, is that we have to make sure that price is actually retesting that support level. So looking at this, we have one rally, okay? And as we're dropping down, price actually retests this support and then rallies from there as well. Okay, so as soon as we have two tests of support where both tests actually rallied from that support level, then we can actually use and trust that support level. Okay, so that's what we need. We need two tests of a support or resistance level before we can actually trust that it's actually serving as resistance or support. And this is an example of buying using support, where a price level actually, or price touches the support level, you could look to purchase it, right? Obviously, this is a super basic understanding of it. If it hits a support, we're going to buy. There's obviously other strategies, other factors that we're going to use as well in order to justify actually buying it at support. But I think the number one mistake people make using support and resistance levels is that they solely base their decisions, their entries, their exits off support and resistance. And I think that's a mistake. I think using support, you have to use support and resistance to your advantage, but that shouldn't be the only indicators or the only factors in trading that you're looking at. And that's what traders do. They tend to just use support and resistance to base their entries off of. You kind of have to use support and resistance with the other knowledge and skills that you possess in trading. And when you combine, the other strategies, with support and resistance, that's when you can make, a lot more higher quality decisions. So don't just use support and resistance. Use it alongside the other strategies you're going to learn in this course, okay? So this is one example where you could buy using support. When it retests the support, you can look to purchase it. An example of actually shorting at support is, let's say we have a huge drop and we start to kind of consolidate at this level. We can kind of think of it, the top of the base as resistance and the bottom of the base as support. And whenever it actually breaks the support level, we could actually look to short it, right? And because breaking support suggests that there are now more sellers than buyers, right? Because during this support level, we could see that in that area, it keeps getting bought, right? Like once price touches that zone, it gets bought. But right when price decides that, okay, once it actually tears through that support, it suggests that, okay, there are no more buyers left, right? The sellers are really dominating. Like there's way more sellers than buyers now in that zone. So we're going to actually look to short it and make money as it continues to fall, okay? So you can either, you could use support to either buy or short. In this case, we're buying it when it retests the support. In this case, we're shorting it when price, goes through support, okay? And I'm not saying that you should be buying whenever we do have a retest or shorting every time it breaks support. These are just two ways you can actually play support, okay? And you might be thinking, okay, then when do we know when to short? How do we know when to buy? Well, that's when we combine the other strategies that we know in this course, such as some of the skills we took from the breakout or breakdown, or the buy setup or sell setup, and the other knowledge that we've learned in this course, level 2 as well, okay? So let's continue on, and we're going to be talking about resistance, okay? So resistance is a price level or area or zone where historical price action has indicated that there's actually way more supply than demand when price actually reaches that point. So in other words, there are way more sellers at that point than buyers, right? And once again, you could either buy or short using resistance. So for example, you could look to sell your position at resistance. Let's say you bought it down here. You could look to sell your, you bought it at support. You could look to sell it at resistance. Or let's say it hits a resistance level, you could also look to short it, right? And you have to make sure there's